Good afternoon and warm welcome to this FESE conference. My name is Peter Koblitz and I'm President of FESE as well as CEO and Chairman of the Prague Stock Exchange. So it gives me a pleasure to welcome you all in Prague. I see so many familiar faces. I see also some new ones. And in fact, in front of us there is a couple of interesting discussions which are very timely because now is the time when we are deciding about the future of European financial markets. We all know that Europe is in the middle of severely challenging market environment. High inflation has been eating into the savings. High interest rates are creating higher costs for companies. We are in the middle of high and volatile energy prices in the moment, which shake the cost structure of many businesses and also the financial situation for consumers and households. As it is not challenging enough, this comes in a time when the European businesses having to adapt to tougher environmental regulation and are facing ever-growing competition from overseas. To aid the recovery and to power the green and digital transition, Europe needs well-functioning capital markets that are accessible and competitive. But how to deliver this? In short, policymakers must not lose sight of a market structure. A well-functioning market structure is key to resilience of capital markets and has a positive impact on a cost of capital for issuers and investors, and in the end, for broader economy. Reforms to the framework regulating how markets operate must boost transparency, liquidity, and fairness, and ensure level playing field between the market venues to produce good outcome for issuers and for investors. This was already intention of MiFID II. However, while some improvements have been achieved, complexity and fragmentation have intensified, and dark trading is prospering more than ever, especially via internalization in bank books. Dark trading contributes little to price formation, and its extensive levels is harmful to overall functioning of EU financial markets, usually diminishing the depths of liquidity available for the companies. Policymakers must change its course. Market should facilitate the capital raising process. All venues should be non-discriminatory and open to all investors. Exchanges contribute to their objectives. We are bringing companies to the market. Primary markets serve as a key financing tool for many European businesses for capital mobilization, while secondary market provides transparency, reliable price formation, and of course, it's tool for good risk management. Recent days we see a regulatory race to the bottom in which Europe follows the UK towards a dealer market structure. This is characterized by high levels of dark trading, and our feeling is that it is a profound mistake. While it is true that too many exciting and innovative EU companies are seeking listing abroad, they are not targeting UK market. They are usually go to US. This is why US market should serve as a principal benchmark for what we see as a competitive and good working market. We should take note that US policymakers are moving to foster lit trading and price formation process, which is the bedrock of trust to the markets. It is a pivotal moment for Europe. The decision we take now will determine our competitiveness and ability to overcome challenges of today and tomorrow. Without efficient and competitive market that investors can trust, the CMU will not succeed, and the companies will look elsewhere and to other jurisdictions for their financing needs, threatening the ability to finance our so-needed digital and environmental and sustainable transition. With that, I would pass my word to Rainer Ries, Director General of FESE, who is our Master of Ceremonies of today. Rainer, the floor is yours.
Well,
Thank you.
Thank you very much for the invitation and congratulations to FESE to organize such an impressive conference in Prague. I would have loved to be personally in this beautiful city, but unfortunately I can only attend virtually. Nevertheless, I'm very honored to give you the opening address today. And let me start by introducing Better Finance. We are the European Federation of Investors and Financial Services Users and hereby represent more than 4 million retail investors, including individual and small shareholders, fund investors, savers, pension fund participants, and also life insurance policyholders. The idea for a union of capital markets was proposed more than 7 years ago in the President's report as one of the pillars to complete the economic and monetary union. The first Capital Markets Union Action Plan was rolled out by the European Commission in 2015 and included a list of 33 ambitious objectives that would strengthen the link between savings and growth. Unfortunately, ladies and gentlemen, 7 years and 6 high-level reports later, Europe's capital markets are not further than their status quo at the moment when the CMU action plan was launched. As the name of this conference suggests, swift action is needed to unleash the potential of our capital market ecosystem in order to attract more citizens to invest in the real economy and in conditions of transparency and market efficiency. Let us look at the current challenges. We see the war against Ukraine, rising energy and food prices, and high inflation rates, just to name a few of them. The main question today is how can we make Europe's economic base more resilient, competitive, and fit for the green and the digital transitions? To reach these goals, we need, first of all, a well-functioning capital market union. Therefore, it is essential that EU capital markets become more efficient and allow companies to access more diverse sources of funding, notably equity funding. Ladies and gentlemen, I think it is grotesque to see that investors in Europe are forced to manage 27 separate different withholding tax procedures, and the same is true in the case of exercising the rights of shareholders across Europe. We cannot ask investors to buy European equity if we are not even able to establish a level playing field within the EU, which means no more barriers between the individual markets in the EU, especially for the retail investor. And to be honest, the huge transformation which is in front of us, the green and the digital one, cannot be done without the retail investor. And to start with, the optimal allocation of household savings to finance growth, jobs, and sustainability cannot be done without transparent and well-functioning market structures. So, from a retail investor's point of view, stock exchanges enable them to securely and rapidly sell or buy an asset at a fair price, and this is called price formation. I think this is very important because it results also in the publicity of the pre- and post-trade data in real time, or at least as close as possible to real time. This is even more important now as research points to an increased appetite for non-professional savers for direct investments, such as listed shares and bonds. At the same time, the so-called do-it-yourself investing is on the rise due to the new fintech models, which brings capital markets closer and more accessible to the average saver. As such, I wish to bring my contribution for today's debates by presenting where retail investors fit in the current landscape, what can be done to ensure that investing and trading is fair and attractive for retail investors, and what are the latter's views on payments for order flow. First, I will set the scene and present you a few details from Better Finance's research on the new retail investing environment and why retail investors and market structures must be considered holistically. Then I will continue by giving you a bit of insight on retail investors' experience with trade data transparency, what our mystery shopping concluded, what are the policy recommendations, and what can be improved. Most interesting, probably for this audience, I will touch upon the topic of consolidated tape. Further, I will speak about payments for order flow and the wider context of inducements. Given it has become a hot topic of debate and it divided stakeholders and decision makers across the EU, I wish to present you that the voice of European savers and investors has to bring this to the discussion. I will conclude my address with a few remarks on where we are and where we should have been and what can be done to correct this situation in the near future. To begin with, ladies and gentlemen, the developments observed throughout the COVID-19 pandemic, namely a large wave of previously inactive savers started investing, receive far too less attention than it should. We noted a steady decoupling of EU households from capital markets in the past 40 years, as they were slowly being driven away through passive packaged investment products. Now, EU households hold a mere 6% of their financial savings in listed shares and bonds. If anything, this is clearly unhealthy as it deprives the EU capital markets of a large pool of stable liquidity. Second, the initial surge in retail investments was felt on regulated markets. Reports from the French, Belgian, Polish, Romanian, or Danish stock exchanges showed a significant increase in the number of trades, which, coupled with a relatively small volume and value, is suggestive of a marked retail presence. This brought about two important effects. First, it cushioned the drop in equity indices during the first quarters of the pandemic. And second, it contributed to reaching historical highs in the market capitalization of EU-listed companies. In fact, academic research shows that retail investors tend to curb the illiquidity curve during phases of market turmoil due to their contrarian nature, which is another reason why unleashing Europe's capital markets must start by considering the needs and the interests of the retail sector. We should not forget the retail investor still is and will stay an important stabilizer of the capital markets. Now, the development of new business models, especially those integrating technology and digitalization in traditional financial services, has brought about positive effects. We should not forget about that. Most notably, it appealed to the younger generation of investors and attracted peers to open brokerage accounts and invest in shares, bonds, or listed exchange-traded funds. Besides a step in the right direction, from a financial planning point of view, it also provides non-professional savers with direct exposure to capital markets, which is a unique tool for financial education. The so-called neo-brokers allow savers to easily open brokerage accounts via the smartphone, see bid and ask quotes, and trade securities on Europe's regulated exchanges. However, there are two prerequisites for delivering an optimal experience and result for non-professional investors. First, transparency of equity and bond trading. And second, accessibility and user-friendliness of delayed market data. In our mystery shopping report conducted by Better Finance in 2021, we observed first that the transparent EU-based regulated markets have seen their share of European equity trading declining from about 70 to only 18% by 2019. This was partly due to MiFID II, which backfired and made the EU the hub for dark pools and systematic internalizers, SIs. From about 14 SIs registered in 2017, the number of SIs took off after the entry into force of MiFID. A very critical development that we observe since then. Currently, ESMA registers show a total of 186 SIs active in the EU27. SIs benefit of several exemptions and waivers, notably on trade transparency. At the same time, Better Finance aimed to replicate the experience of the average retail investor when seeking pre- and post-trade data for listed equities. At the time, the findings were suboptimal as just a few of Europe's largest execution venues by volume fulfilled all the requirements imposed by MiFID II and MiFIR. While no changes were done at EU level, some of the market operators surveyed in the report did bring improvements to the manner in which delayed trade data is presented, making it easier for the average retail investor to find bid-ask quotes and prices at which orders are executed. Among the recommendations put forward to improve the status quo, Better Finance included two. One on European consolidated tape and another one for systemic internalizers to ensure that investors enjoy optimal outcomes. EU capital markets must foster adequate price discovery and formation mechanisms, which can only happen through lit trading of retail orders, regulated markets, and lit multilateral trading facilities, MTFs. Retail investors must easily access pre- and post-trade data to be able to make informed trading decisions and also evaluate best execution on their orders. In practical terms, this translates to a consolidated tape that allows ex post verification of obtained prices and best execution deals by investors. What matters for us is that individual investors can ex post easily and freely check whether their order have been executed in the best of their interests. Therefore, all retail orders must be precisely time-stamped, traceable, and include information on the precise market venue on which the order was executed. Our proposals for the consolidated tape, I just would like to summarize them in short. First of all, to start with the bond markets. Secondly, to ensure that the consolidated tape does not distort competition in favor of opaque, non-transparent venues. Third point, to increase transparent trading in the EU. Fourth point, to reduce further market fragmentations and to avoid retail flows to go to SIs. Finally, we also want to make sure that the consolidated tape is freely accessible in a user-friendly way to retail investors. This bridges my address to you today to another highly debated topic, that of payments for order flow. Last year, EU authorities started the review of the main instrument regulating market structure at EU level, the MIFIR, the Markets in Financial Instruments Regulation, which I'm sure is on all of your minds. Sparked by the GameStop and the AMC cases in the US, the practice of PFOF, as we call it, was steadily uncovered as creating many challenges and posing many risks, also to the detriment of retail investors. PFOF were the backbone of new brokerage business models that proposed user-friendly, low-cost trading for non-professional users. Better Finance looked at the revamped business models that attempt to put the retail investor more in charge, to which we generally refer to as neo-brokers. The latter have become very popular for the low fees, sometimes even zero commission, services accompanied by direct access to a wide range of securities and to a do-it-yourself investing. However, ladies and gentlemen, the question we all seek to answer is whether PFOF is really beneficial or not to the retail investors. We looked at available evidence, including qualitative and quantitative data. Unfortunately, our key findings are that PFOF can create the illusion of free trading as it hides implicit costs, leads to conflicts of interest over best execution, can distort competition, and ultimately trigger an overall price deterioration for all investors. After all, even neo-brokers need a well-functioning business model which has to make profits one day. Retail trading must be simple, transparent, cost-efficient, and done in the best possible conditions for individual, non-professional investors. Our most important concern is that PFOF create a conflict of interest between the brokers and the SIs, which is definitely not in the best interests of the clients. While the best solution firmly remains a straightforward ban on inducements, including PFOF, certain alternative solutions can be looked at in order to deliver a high standard of investor protection and ensure that retail clients are delivered the best outcome. Let me conclude, ladies and gentlemen. Investors' trust is an essential condition for their participation in capital markets, and to build such trust, transparency is key. Today, we know that retail investors are stable shareholders that induce long-term sustainable capital. This contributes to favorable conditions for IPOs in the primary market, as well as for the company's onwards life on the secondary markets. By all means, the EU's economy and its capital markets are facing challenging times, and the long-term and stable funding source of EU households will be desperately needed more than ever to bridge this phase. At the same time, EU savers need more retail investments to hedge for future financial needs and to ensure that their savings yield better results, especially in times of high inflation rates. To maintain the current large wave of investors into EU capital markets, the young ones, but also to motivate their peers and future generations to invest, the EU needs to deliver an investing ecosystem that is fair, cost-efficient, transparent, and ultimately attractive for non-professional savers. As mentioned at the very beginning of my address, a lot of time has passed and many reports or action plans have been proposed and revamped in order to build the Capital Markets Union. Unfortunately, at least that's my view, the results so far have been suboptimal, which should prompt us to consider direct, firm decisions that will shape for the better. I do hope for our union and its capital markets for the next decades to come. So, thank you very much for listening to my speech. Thank you for your patience. I wish you all an inspiring conference today, and I'm sure it will be most successful and interesting. Thank you, Rainer.
Well, thank you very much, Jella, and I think welcome everybody to our first panel, MIFIR, How to Get the Balance Right. And let me briefly introduce our panel in alphabetic order. So we have Niels Raab online, Head of Group Regulatory Strategy and Chief Regulatory Officer of Deutsche Börse. We will have Professor Hübner, who has to leave a bit early to attend a hearing in Parliament. And Professor Hübner is member of the European Parliament, a former commissioner, and I think since 2009 in the Parliament, and more pertinent to our debate, she is also the rapporteur of the MIFIR file. Then we have Phil McIntosh, Senior Vice President and Chief Economist of NASDAQ, who can certainly shed a light from the US perspective on market structure, consolidated tape, etc. And next to me is Alžbeta Pasterková. She is the chair of the Council Working Party on MIFIR and in the Czech Finance Ministry, and obviously also very involved in the file. And let me just maybe give a few thoughts as an entry to the panel. I think if I look at Spotify, BioNTech, Linde, who have all decided to turn their back to European capital markets, it's very often liquidity what they cite as the reason to go to the US, and Phil can maybe comment on that later on, but I think they see liquidity and valuation in the US are much better than in Europe. And if we look at the last 20 years, it seems Europe is losing out to Asia and the US in terms of capital market development. Our share of market capitalization as part of the global GDP is going down, and it seems companies are looking to go elsewhere. So certainly MIFIR is probably one of the core things to look at to be competitive. It is the European Constitution and the framework we give ourselves for capital market when it comes to transparency, integrity, and fairness. And I think that's very much what Jella was alluding to. Investor trust at the end of the day is key, that I think the optimal price is found and that capital is allocated to the most efficient use. And as such, I would claim MIFIR is very much at the core of the capital market union. Without efficient capital markets that investors can trust, I think a capital market union will not be successful. So for our panel, it's a little bit the question to ask, how do we get that balance right? How do we make MIFIR work? What market structure do we need to choose to be competitive again? That companies don't say our markets are not liquid enough to stay in Europe. How can we encourage more lit trading, or is it better to actually move to a dealer market model, which I think is more the UK example? Should we ban PFOF, or should it be the new default for retail trading? What role does the tape really play in that? Is it something that helps in transparency or allows new business models that maybe are an unlevel playing field? And how is it really linked between market structure, best execution, good outcome for investors? What role does the CT play? So I think a lot of very interesting topics to cover. I would maybe ask first Alžbeta to give us a little bit a status of what's being discussed in council and where we stand, and then followed by Danuta, who will tell us about what is being discussed in Parliament, and I think then we'll enter into the debate.
Good afternoon. It's a pleasure to be here. It's a very interesting question, how to get the balance right. Let's say that we have been trying to find the answer in the council for the last couple of months, and we are still looking for it. Hopefully in the end we get the balance right, but the question is where it lies. The council is the constellation of 27 member states, and the compromise is always there. The compromise is what is agreed between member states as the way forward. So that's the situation we as a presidency trying to follow and trying to reach the compromise among the various opinions of member states they have. I would start with a market structure and so much famous double volume cap. It has been proposed by Commission to drop double volume cap, and Council has a problem to agree in MIFIR on almost anything, but they can agree on that the double volume cap costs much more than it's worth. So there is definitely agreement that we need to move beyond double volume cap in a market structure for equities. The question is what should replace it, and that's kind of harder to find. There is debate and potentially also situation for single volume cap. Of course, then the question is what would be the cap and what level should we set the balance. And based also on the new proposal on in UK on a wholesale market structure revision, there was a proposal, and we have also put it on the table to remove a cap altogether and propose to have more open market with potential powers for Commission to step in if the dark trading would overflow or reach some certain limit that would not be acceptable. So we are balancing in a council between more flexibility and to more allowing markets to actually show what is capable of or not, and about having a single volume cap at the moment. I would say the discussions are still ongoing, so I can really tell you where we land, because this will very much depend on the majority of member states. As for the SI regime, French have found some kind of balance on regulation, yet again, based on the UK proposal, the member states have tended to be and required to be more lenient and more flexible in the upcoming not easy times, as was mentioned a couple of times here today already, that Europe will be facing more stringent, more strength on liquidity, and more flexible regime might be more appropriate to address what is coming in a way. But again, that is still open for discussion, and we still don't know where we exactly land on this. And then there is the debate on never ending and never decided PFOF. As you all probably know, the Council has ended up in a deadlock. And the PFOF, we're having a blocking minority on requesting for PFOF and having strong majority on being very advocate for the ban. So we are in a very intense debate in the Council to find a potential solution. For sure, I can tell you that we are trying to build a solution on what is already in a MiFID. So we would very much not like to deviate from the concept of best execution as is in the MiFID, which constitute of a price of financial instrument as well as a cost of settlements and so on. So we are definitely trying to build on that. The idea is to have a limit on what is considered to be appropriate price of financial instruments, and the arguments are tending to be in the spread of EBBO. That would be potentially or maybe included in the consolidated tape. And of course, then there is a question whether, and again, member states tend to agree that there is reason to limit a cost as well. So there would be a guarantee for the retail investors to have actually, let's say, the best possible execution in Europe. That much from my side.
Danuta, do you maybe want to comment, Professor Hübner, from the side of the Parliament?
Yeah, I hope you can hear me, right?
Very well.
Yes, I even hear myself twice. Yes, so it's thank you very much for reaching out also to the Parliament. And I could start by saying that we have 705 members and 8 political groups and 27 national interests. So it is, like in the Council, also extremely difficult. And we have started already now the discussion at the political level. So we are probably much beyond or behind, rather, I should say, the Council, but we are waiting with a lot of interest on where the Council is moving with individual issues, which are also very important for us. We also have the amendments that were tabled in mostly focusing on consolidated tape, the market structure and transparency, and also the best execution. We have started already negotiating the compromises. We had the first meeting on the compromises, and I think we are largely sharing the starting point and the general objective of this review of MiFIR. I think we are fully aware that this comes in a time, at a critical time for Europe, and that I think we all know that Europe has no other option but to get a bigger, stronger, more competitive, more unified, respecting level playing field with simpler rules, capital market. Otherwise, I think we will fail also with all the big ambitious programs of investment we have. We also understand fully that in the current context, we have to look at other jurisdictions. We should not be rule takers, of course, and we should not engage either in a race to the bottom or to the top, depending on the perspective. But we should probably spare no efforts not to make the situation worse and penalize the EU capital market participants with our rules that would not be sufficiently conducive. So we have this feeling, this burden on our shoulders with us all the time. But we are also fully aware that Europe has a wide diversity of market participants, that also the measures that we will put forward should not create a situation where capital would go away from the Union. We should rather create really an attractive environment. That we also agree. We also believe that this is the time where we should consider giving enough powers and flexibility to ESMA as European supervisors that could take decisions based on data, which is one big issue not yet mentioned, and also that can adjust the framework based on market evidence and also market changes. So this is the direction we would like to take. And the file is, of course, very technical, but it's also strongly political, I would say. And we clearly see that there are different national sensitivities in this file. There is also this big challenge that we have been always lagging behind the jurisdictions such as the US, or we also compare ourselves now to UK. And the conclusion we have from that is also that we have to increase the competitiveness of European Union capital market. And we have to cope with all those differences between capital markets in different member states. And there are in some parts of Europe, I was thinking specifically about Nordics on some issues where we have also a lot of good examples that we could use. So we today, I can say that actually nobody among those who negotiate questions the introducing of the consolidated tape for reasons which are important to identify, I think, because that then act on the different measures in different areas that will influence the functioning and the role of the consolidated tape. So we see it as a price comparison tool, and we also, which we lack today, but we also hope that it will be done in such a way that it should reduce, that it would reduce the cost of market data, which are, I think, often today hindering a lot of developments in capital market and financial markets and in other markets as well. We also see as a shared objection the strengthening of the EU lit venues. And we propose to do it through reviewing upwards the thresholds for the use of the reference price waiver. Also review upwards the thresholds for SIs activities, and also addressing the issue of PFOF, which is a practice actually that can reduce the retail flow going to lit venues. And then we largely share across the political groups also the need to empower ESMA to calibrate all those measures. And if we have the ESMA on board, this would ensure that the thresholds and rules can be adjusted if market changes and can be also implemented with the support of what only ESMA has.
No, I could not hear her, but
from the markets. We also agree that if we manage to simplify, we are not very successful in the European Union with simplifications, but simplifying the current transparency regime which has proven already, I think, to be too complex and too burdensome, by harmonizing the deferrals regime for non-equities, or proposing also to suspend what Madame Pazerkova mentioned, the double volume cap, which I think proved to be arbitrary and ineffective. So the simplification is important, because hopefully it would reduce also costs, and it would produce also incentives for the greater participation. We of course regret that we cannot, because we talked about it as well in the Parliament, we cannot use the MiFIR to go beyond the MiFIR review, and, for example, to cope with the integration, or with the need of integration of the trading and post-trading infrastructure, as today we know that the costs to trade set clearing are very high when we do it the way we do it. We hope that the review of listing rules will also come next year, and will also incentivize more companies to trade in Europe. And I also hope that we will have a revision of the fiscal rules around equity ownership. Whether going back, just for the last sentence, going back to this other jurisdiction issue,
thank you.
Was asking, I think you can always learn from others, and you should learn from others, but to see the unified, very different jurisdictions as the right benchmark for European Union solutions, here one should be very careful. I think we are not a unified jurisdictions. Unfortunately, I must say, it will not come tomorrow either, and there's a lot of specificities which we need to consider, and we should see the other jurisdictions what they are. Actually, they are competitors in terms of attracting capitals, and especially the American market is a universally extremely attractive, and it's also a global reference point in terms of attractiveness and the overall size of the capital markets. I hope our size will also grow. So what I think, therefore, just to finish, is that changes, when we talk and when we will be introducing the agreeing on the changes to the European capital markets in Europe, we should always consider the international competitive environment. I think this is fundamental, and that's why when we look at UK, when we look at the US, we can learn a lot. But first of all, we have to see that that's our competitive environment in which we also should one day maybe should be more winner than loser. That would be my introductory remarks. Thank you. Probably I should say we are planning to finish the negotiations by the end of January. So if the Council is done by that time, we could then quickly move forward.
Perfect. Thank you very much, Professor Hübner. And I would maybe give the floor to Niels Braab. Niels, and maybe for the structure, I would, in the first part of the panel, try to discuss equity market structure, and then later on move to the tape. So we have, I think, the two debates maybe a bit separated. And we just heard from Yeller, I think investor trust is important. Professor Hübner and Alžbeta stressed that really competitiveness is important. If I look at the reality of, for example, Deutsche Börse, Linda has said they're leaving to the US. How do you view competitiveness? Who is actually in market structure the competitive benchmark that maybe you need to aspire in terms of liquidity, in terms of competitiveness, and how do you view the equity market structure in Europe, you know, lit versus dark, PFOF, systemic internalizer? Is that a good starting point, or what do we need to do?
Yeah, thank you very much for that, Rainer. And let me also start by wholeheartedly thanking Professor Dr. Hübner and Ms. Pastakova for taking the time in their extremely busy schedules. That's really much appreciated to have an important exchange on the ongoing MiFIR review. I will indeed, Rainer, as you mentioned, first and foremost, jump a bit into the market structure reflections before then happily tackling the consolidated tape conversation in the second part. I think that Europe is sort of standing at a crossroads is very clear from the global perspective, right? And I think that's always a key reminder to all of us. We see extremely high levels of inflation at the moment. We see very much so constrained public finances and heavy and high debt levels in light of many of the emergency measures that had to be done the last couple of years, be it around COVID or Ukraine. And I think this is being paired, of course, with this monumental financing need that we see, especially also in light of the digital and sustainable transformations. So that leads us to assume that capital markets will continue to be absolutely critical for the future of the European Union. I think we are all very clear that the endeavors over the last 2 decades have not necessarily rendered the benefits we wanted to see in the markets. And when we look very concretely then at the MiFIR discussions, this is, of course, as Rainer alluded to it earlier already, the sort of heart piece of the European Union's securities markets legislation. And as such, of course, the ongoing review gives us a great opportunity to target the framework more to the current needs of the equities markets in particular. If we look into some of the key proxies, however, I think it's also important to remind ourselves where we stand in terms of total IPOs. We've seen 2,700 of those last year globally. 60% of those went live in the US and Asia. Only 12% went live in the European Union. When we look at market cap, for example, the US market is standing at above 190% of their GDP. In the EU, we manage only about 50% of the GDP. But even more so, we have some critical indicators. Rainer just alluded to it. EU companies are moving abroad. We see that the EU equity markets are increasingly seen as unattractive. And in Germany, we've just basically seen the decision to delist from our stock exchange in terms of Linde, which is the biggest company in the German index. But I think it's also critical to not lose sight of the citizens' reality in terms of participation and ownership. When we look, for example, into the German DAX, we see only that 12% is being owned by the Germans themselves, 40% is owned by US investors, and about 20% by UK investors. And finally, to finish off on a very sort of dark and alarming picture, we see especially this year, a very, very pronounced outflow from EU equity markets. In the first half of this year, this was about 31 billion. That's the highest in many years. I think last year in 2021, all of the outflow combined was only about 3 billion. And at the same time, we see a strong inflow into the US markets and partially also the Asian markets. So starting from that benchmark, I think really important to reflect on the MiFIR market structure discussions, where we want our markets to be and how we want them to perform. I think generally speaking, when we look at some of the sort of main objectives that MiFID II and MiFIR had when being introduced in 2018, especially around transparency, it seems that we've not fully delivered on what we promised. I think that holds generally true as an observation across all of the asset classes. Is of course traditionally more pronounced also in bonds, where we see an extremely intransparent market picture as such. But on equities in particular, I think it's important to remind ourselves that more than 200 systematic internalizers have been created with the introduction of MiFID II in the course of the last 4 years. And also, when we look at the actual market share realities, we see that the SIs are nowadays coming in with about 27% of the total market. Exchanges are only coming in with about 28%. So it's pretty much on an equal footing. But the key point for us, of course, to highlight is that there is no fair competition in the market as such, right? Because the systematic internalizers of this world run under very different and specific regulatory requirements, which is not the same case for the exchanges. And that's also, I think, getting even more problematic when we pair it with the latest observations in the markets, be it, for example, around payment for order flow, where we see de facto a sort of institutionalization of conflicts of interest. So if I look concretely then into the sort of outlook and what we believe would be critical to obtain, and that also goes back to some of the important points made by Ms. Hübner and Pazdakova. I think on the dark trading cap, I would fully agree that the double volume cap hasn't functioned and was a pretty meaningless instrument under the current MiFIR framework. The question, though, for me would be, is it then the right approach to delete the dark trading cap if in the first instance it sort of hasn't rendered the results that we actually wanted to achieve? I personally believe that the Commission has made a solid proposal by proposing to introduce a single volume cap, which we very much support. We believe this should be tweaked slightly, however, to first and foremost include really all of the market. I think even in the drafting of the European Commission, not everything would be captured, and we see in particular the need also to be sure that a single volume cap would capture systematic internalizers and also frequent batch auctions, which could of course be the big winner of some of the currently discussed reforms. I think the other key element for me is really around the SI regime in itself, where we would believe that it would be important to establish an authorization and monitoring regime. That's definitely, I think, a good starting point to making sure that the regulatory parameters are being complied with. But it's certainly also needed, and we come back to that later in the debate, in terms of market data quality and the needed data for the consolidated tape endeavor. Second point for me on the SI regime would really be that we believe it would be better to box them really into large and scale transactions, make sure these vehicles are being used for what they were originally designed for. I think also the colleagues at the AFM had published an excellent study on this, showing that the average trade size in an SI in Europe is only about 37,000 euros, and with that, for most of the instruments, very, very far away from what could be considered a large institutional transaction. And I think moving on from there, we believe that it would also be important to sort of look again into some of the level playing field dimensions between alternative execution venues and the regulated markets and MTFs of this world. I would probably leave it at this for the first round, and then happily dive into some of the more nitty-gritty points in the second one.
One comment from reading the Financial Times, there I think is a trend for MTF business to also move to SIs and people giving back their licenses. So certainly the trend in Europe seems to go to more dark trading. Phil, you're maybe the judge out here, and I think you have a lot of academic papers that you've written on the European and US markets, so I think you understand market structure on both sides of the Atlantic very well. What are we doing right in Europe when it comes to lit versus dark? What are maybe lessons to be learned from the US? And maybe, I think I just watched over the weekend Eat the Rich, the Netflix series on payment for order flow. Maybe you can also tell us a bit on what should Europe do? Ban payment for order flow, or basically make it the new default model for retail?
That's a pretty big question. Just listening to everything that is being talked about, though, I mean, it does have a lot of parallels with the debate that's happening in the US right now, where essentially the SEC is talking a lot about segmentation. They're not saying segmentation, but there is a lot of research on segmentation and the impact of that in the marketplace. And segmentation is different than fragmentation. Segmentation is your bilateral relationships. And what that allows you to do as a market maker is participate in spread crossing trades that are profitable and avoid spread crossing trades that are less profitable. And so one of the problems that we have, and it's kind of been touched on already with the level playing field, is exchanges globally have mostly been set up with one of the core principles being fair access, which means everybody has to make a quote to everybody, which means you can't segment. So what ends up happening when a marketplace can segment in one half but not in the other is the participants that can segment will participate with the less toxic, less informed, more retail flow and make money off the spread crossing orders there. But what that does is it leaves the flow that's actually coming onto the exchange, where those market makers are making the only prices that are being used as a benchmark to determine what best execution really is, with much more informed flow. And so they tend to see much stronger markouts, losses on their facilitation trades or their market-making trades. And so you end up with a problem where the NBBO, in our case, is relatively informed, and it's kind of like the trade of last resort. You try and get an SI fill, and you try and get a fill in the dark on the near touch, and then the far touch, and then eventually you go to the exchange and you actually trade on the exchange. the market makers that are making the prices that all those transactions rely on only get a trade at the very last instance. And so you sort of have this waterfall where the market maker that's making the right price for the market is the one that gets the last look at the spread crossing trade. And usually that means it's the most informed or the largest or the one with the most market impact. And so I think the SEC here has been talking a lot about whether the NBBO that we have is actually as good as it could be when there's a lot of segmentation in the US. So we have arguably about 40% of the flow is off exchange and internalized away from dark pools, maybe another 10% in dark pools. So you get close, at least during COVID, you got close to 50% of the market actually being off exchange, relying on those market maker quotes from the exchange, but not really paying anything for those quotes. And so you end up with a marketplace, and there's a lot of academic research that's been done, not just by me, that shows that if you do successfully segment less toxic flow into other marketplaces, into bilateral markets, that the quote itself gets more informed, is what the academics call it. If you're a market maker, that means it's more toxic. So you make losses on those trades. And eventually, if you make losses on those trades, you're going to have less volume and depth on the touch that's visible for an investor. And eventually, the spreads are going to get wider as well. And it's a little hard to really show the spreads are getting wider with all the volatility movement that we've had in the last 10 years. But we've done a couple of studies that seem to indicate that if you normalize for volatility, that actually spreads are starting in the US to drift wider. So there's a couple of academic papers that talk about tipping points where the market can get too dark. Some of them say 10 to 15% is too much dark. One of them says 50% is too much dark. And arguably in America, that's the level we're at, that 50% level. And we are starting to see the depth on liquid stocks is falling. And the spreads are actually starting to get wider after you adjust for volatility changes.
I mean, maybe to pose my question a little bit, Anuta, and also Alžbeta, referring from the discussions in council, I think there is a little bit the tendency to think, should we aim after the UK to liberalize more, to make dark trading, I think, more the standard model in the EU markets, to potentially allow for PFOF, sort of watching from the US, you would think, I understood you were alluding that you think that would widen spreads probably in the long term.
Yeah, if you can, I mean, it's just, sorry, I just looking at the relationship of informed flow versus not informed flow. I will stop.
But were you going to say something, Phil, or no?
Sorry, I can hear an echo. I thought it was somebody else talking.
No.
So 100%. If you think about the relationship of how PFOF allows you to create a relationship with a specific subset of the market, then you're actually saying, I want to trade with you exclusively, and that's the flow that I can make more money off as a spread crossing flow. And so PFOF does, just like having segments in dark pools, allow a participant, whether it's a market maker in the dark or an SI in the dark, to make sure that they can trade more with the less toxic flow, which kind of by definition leads the rest of the market with more toxic flow on exchange. And so the market makers that are making those EBBO quotes that everybody is relying on are getting paid nothing for sitting there providing the quotes, and they're actually not even capturing the spread until the liquidity inside the spread or in the dark pools has run out.
Professor Hübner, maybe as an economist, I think, are you discussing a little bit the market structure, payment for order flow? Because that's what I'm missing a bit in the debate, that we're very segmented discussing consolidated tape or PFOF. But I think in the US you have this linkage between best execution, consolidated tape, mandatory consumption, market structure. Is this a debate in the parliament?
Yeah, well, we had discussions so far on the proposal by myself, and we had the discussions on amendments, and then we are now starting the discussion on compromises. And not all the issues are there, but my understanding of what I hear from the colleagues from other political groups so far is that, especially on PFOF, if you ask me, this is going to be, when it will come to the decision, we keep it for the end of the negotiations. when it will come to the decision, this will be probably the most difficult discussion that we will have. And we continue to have basically these three options on the table. So to maintain the status quo, or to go for the total ban as the Commission has proposed, or to rather go towards a compromise that would seek to allow the PFOF, but only under certain conditions. This is actually what I propose in my draft report, trying to the compromise is trying to move us forward. I think we clearly, there's agreement, like I think also in the Council, in the Parliament, and I understand everywhere, that when you talk about the PFOF and what next step, we should look at it in the context of the best execution framework and how the best execution framework indeed work. I remember from my more than 40 meetings, I think, with the stakeholders, that some of you were saying, don't touch best execution because it's absolutely perfect. And some were saying, do something with the best execution because it is so loosely worded in the MiFID level 1 that there are very different interpretations at national level. And to have the supervisory divergence of interpretations is something which I think we shouldn't have in Europe. So it's just strange that we continue with national supervisors with radically different position. And now we are looking also towards the solution. And of course, the tape, which is not a panacea for everything, but to a certain extent, it can be one of the elements that can help to ensure that the best execution framework can be improved. But then again, it should be rather a pre-trade tape that could be even more important in this context than a post-trade tape, because it could show a benchmark against which the brokers will be required to prove that the price at which they are executing was the right one. And I would be very happy to hear details from the Council, but I understand that both French and now Czech presidencies, they had some ideas, and let's hope that we will move in the same direction. Then you have all the studies, because there was no impact assessment by the Commission. So you have the studies which are absolutely clearly proving that the PFOF is detrimental for retail investors. Then you had recently, there was a study by the University of California, which is suggesting that there is practically, there is no worse, that PFOF venues do not cause worse execution for retail investors, but they offer them prices comparable to those. There are ESMA's comments as well that is saying that the PFOF can sometimes lead to brokers not acting actually in the best interest of their clients. So I personally believe, and I hope that I will take colleagues in this direction, that one way to solve the issue would be to assessing the best execution by comparing the execution price at PFOF venue against this benchmark, such as that one of the tape. But also, it is clear that disclosure rules for brokers should be strengthened, and I think, and this should be more transparent, and brokers should be required to provide clear and intelligible information to their clients. They should also probably be asked to make public aggregate information. So I think that we are basically moving in the direction that PFOF can be allowed under certain conditions. So you can continue without PFOF if you are a broker, but you can move to PFOF, but then you have to meet those conditions. So that's actually where we are currently, and which way we will go, we will see. On lit, I don't know when you want me to say something on lit and dark, because that's also an important element also for us in the Parliament. So I'm ready to comment whenever you will see that I should say something.
Let's maybe go to the PFOF for a moment, and maybe first to Alisbeta and then to Niels again on the PFOF. I mean, if I look a little bit at it, if I read the last compromise proposal that the presidency put forward, I would say there's of course a lot of incentive for, if currently PFOF is a bit in the gray, I would say, it's a question whether it is permitted or not permitted. Actually, one Commission official in a Parliament hearing said a while ago that he thinks it's not permitted. Well, we're having now a debate to potentially allow PFOF. So if it would be written in the regulation, obviously it probably would become the default format. And we've heard from Phil that, you know, if you have more in the internalization model, in the segmented way, the toxicity of public exchanges, of public markets would increase, and probably spreads would widen. Equally, Danuta has said that much of this has never been through an impact assessment or scrutiny. Is that discussion happening a bit, how to actually get more evidence to be sure what we're doing, or is that sort of, what's the debate there at Council?
Yeah, the PFOF. I would like to echo actually Professor Hibner that we need to look outside the EU to see the practice, to see what is actually happening outside and inspire, but not to take over, and definitely not take over the wrong practice that might be considered to be happening in the US. So I would say that Council very much agrees that we would not like to have the US practice in Europe. That's definitely a starting point for all member states. Of course, when where we end up, that's a question. There is a requirement, and I think that it's also pretty much agreed that and the PFOF in a council, we're definitely building up on the best execution in Article 27 of MiFID. So we are not trying to deviate from that practice, and we are definitely not trying to deviate from what is already in a MiFID. So the interpretation there would hopefully stay the same, even though, of course, it would be further streamlined with further conditions that would be added. But as the Council is debating how to actually set further conditions for the PFOF if it is provided and used, it also says that if this better execution at the EBBO and the lower settlement cost is not able to be reached by the PFOF provider, then the order has to be set at a, let's say, lit venue. So there should be conditions making sure in the end that this would not be mainstream practice, or that we would not lead to the actually broadening the spread of EBBO. But of course, depending on where we land and how exactly the wording of PFOF would be, which we still do not have fixed because the debate is really ongoing, and there are member states who have invested a lot in this and have very strong opinions on the PFOF.
Niels, briefly comment on PFOF because you didn't mention that before.
I mean, I would always approach the debate from a perspective that Bernie Madoff was the one who invented PFOF, right? I think that's always important to remind people of. That's the guy who operated the biggest snowball system in financial history ever. Second observation I would make is that generally the conflict of interest seems extremely pronounced in PFOF, and I think clearly to Phil's point, exchanges do not operate such setups and are non-discriminatory in nature. By contrast, what we see here is, of course, that companies that have an own interest in proprietary trading are using PFOF also as a means to intermingle with the execution of customer flow. So generally speaking, and also sort of observing what has happened around GameStop, I think there is a profound need to look much more into the detail. Our perspective on PFOF is that a ban would be outright the best. I think the Netherlands has shown also that this works. Their market for retail investors in particular is pretty vivid in EU terms. But I think clearly if a ban will not be the way ahead, there must be much more transparency around PFOF payments. This must be publicly disclosed, not only to supervisory authorities, because I think the general public and especially end investors should have the ability to look into this. There must certainly be a means to enforce best execution also for PFOF. And I think it would be odd to provide sort of for a standard deviation formula that allows PFOF providers to not provide best execution. So these are my main observations on this. And I think, again, preference would clearly be with the ban. if a ban cannot be materialized, it should definitely be a meaningful setup which doesn't provide so many loopholes that essentially by the end of the day, the current P4 practices just continue in the internal market.
Perfect. Professor Hübner, I understand, needs to leave a bit earlier from the panel, so let me give her the word first now, because we haven't really mentioned, you wanted to say something about lit versus dark, and also maybe you can give us an intro into the consolidated tape, which we thought we'd discuss towards the end of the panel. Is it the silver bullet that will solve the ills of the European structure? And Phil, is it going to be next?
Okay, thank you. So yes, I'm totally open. If anybody has a silver bullet, then if you require, just demand it. I think on lit versus dark, this is a just issue which also is extremely difficult. My understanding has always been that the Commission, when the Commission prepared the review, they wanted to ensure that the share trading on lit venues in the Union is approximately in line with ratios which we can see in other international financial centers. When I was then listening to FESE, Nasdaq, Deutsche Börse in my meetings, I understood you told me that there has been a market decline in the share of trading taking place on lit venues since the introduction of the first MiFID, which introduced competition to the capital market and among the venues, and that this is actually detrimental for the price formation. But then there were other stakeholders who were saying absolutely something different, that lit platforms have maintained the market share in the EU. So I looked to ESMA, and ESMA in its report is saying that there is no evidence that we have in Europe a problem with the way in which prices are formed in the markets of Europe. So I just think that there is, it's a very difficult question. What is the right balance between dark and lit trading? And the only way we can approach it, I think, is to look carefully at how to calibrate all the rules which influence that balance. I think that's kind of imperfect maybe way, but the only way to go, and how they maintain, those rules will maintain the level playing field between market participants while avoiding the risk to price formation. And we discussed in the parliament, one idea is to increase pre-trade transparency by limiting the use of reference price waivers, which we are proposing higher thresholds to use it. And this should drive smaller orders to the lit venues. Then also there is this option which we propose of suspending and monitoring the so many times mentioned already cap mechanism, which is limiting dark trading under these waivers. And as these caps were set, we believe arbitrarily and proved to be of limited utility. And then we are proposing, unlike I think the council that is going to get rid, we have proposed initially the suspension of the cap that would reduce complexity and align the union with international practices. So to address the risk that the absence of caps will increase then the amount of trading in the dark, which is counterbalanced by higher limits on the use of RPW. So ESMA would be given the power to monitor and intervene when the proportion of dark would go too far. And so these two measures, we hope, the higher RPW and the suspension of caps and the role of ESMA, could strengthen the lit venues, but also make the regime more flexible and would give what is important for us in the parliament, a greater role to the European supervisor, which is ESMA. So this is in very short how we see it. So trying to shape the rules that finally decide on this balance between the lit and dark. On the consolidated TEP, I think everybody has been already said. We agree in the parliament, with small exception, how we should trigger the whole process. We are not yet with the decision. But we think that we have to, it's not only about the tape as such, but also how with the whole structure of the regulation, how to use the chances that the existence of the consolidated tape is giving us. So in terms of the many choices for investors that are good from the competition maybe point of view, but there are market data fragmentation. So the tape is just aiming at this market data fragmentation, but there is also a lot of work on the data themselves to be done to make the consolidated tape really benefit from the data. Then we also know that when you have fragmented markets, it's difficult for investors to navigate through the markets. So that's why giving them the consolidated view is not a formality, because it's not only the prices, best bids and the offers, but it's also the information about available stocks, so you can make comparison across venue. Then we know in the European Union that we also suffer in the capital market from this, from the fragmentation alongside the national borders. And here again, the tape, if well done, can at least partly resolve this current home bias in trading. It could facilitate also the cross-border retail investors flow, which would be good then for many other things, many other objectives. And then I also think that what we have to admit is that the tape would benefit asset managers of smaller sizes, and also the funds which manage the money of European retailers, retail investors. And so it could bring direct benefit also to retail investors across Europe. But, and this would be the last sentence, I also think that the EU markets as a whole, including all participants to the markets, it would also benefit, because the tape could potentially increase the attractiveness and drive also more liquidity and more trading overall on to regulated markets. And it could also enhance visibility of venues that today are hidden because of the selection bias of investors. So I think that when we look at the consolidated tape, I would say that the question of the speed, how fast, which are also just, you remember we started some months ago, we had the discussions about end of the day, then we had 15 minutes, but now I think everybody who is just taking floor in the parliament is calling for a 1 minute delay. There are also many amendments on this, but then also there are those who need really real-time information to trade. For example, if you have in your shares the pension money, it's just slightly different situation. So I think taking into account that 15 minutes is already actually available, we should go probably to much more ambitious on timing of the tape. So the tape it's also an area which is not really already discussed and boring, but I think there is a lot of choices still to be made that can allow us to fully exploit the potential that the tape might give to this fragmented market of very diverse, different interests and different participants. So that will be probably my comment on the tape.
Thank you. Well, Phil, again, you're the judge out on Europe. You have a tape for many years. It's real time. It's pre-trade, national best bid offer. What are the lessons for us? Will it be the magic bullet that will help us to be liquid and grow as a equity trading center?
Well, I think given what processes we have in place here right now and all the debates we have, the answer is no. But what the tape does do really well is creates a virtual solution to the fragmentation problem. It does not do very well real-time data, if nothing else, just because of geographic latency. And that's one thing that we're learning in America, is that it doesn't even matter if you're all located in a small state of New Jersey, you still have speed advantages if you're sitting at the exchange where the trade is happening versus at the exchange where the quote is being collated versus somewhere else in the world that has to get it on a third leg. And so the speed argument, like getting anything to actual pre-trade, is impossible. When you look at how market makers set themselves up, they co-locate in exchanges so that they know exactly when their their orders are acknowledged and when their cancels come back and when their fills come in, so that they have very fast information about what's going on in the exchange. Everything else is delayed. So even a direct feed to someone in Secaucus, which is where a lot of the dart pools are located, is delayed just because of the time it takes for the message to travel down to Secaucus. So the first problem that you have is you will never solve the speed problem. And I think there's a point where the idea of the tape is to socialize the MBBO for investors, and most investors are eyeballs. They're retail investors. They're even broker dealers sitting on a desk with a Bloomberg or a Reuters screen, and they cannot react any faster than about a third of a millisecond. So to speed up faster than that means you're really starting to invest in solutions for sophisticated investors. And I would argue for those sophisticated investors, there is never a solution that's fast enough that sort of beats having proprietary feeds that they can do what they want with. The other problem that you have is with a segmented market, creating a socialized NBBO or EBBO, you've got to work out how to actually structure the economics. And I don't think we've done a very good job of that in the US. We started with a pretty cool idea, which is we're just going to have the top of book. It's going to collect revenue from everyone that wants to buy, and it's going to allocate it back to the people that are actually creating price discovery, whether that's quotes, which is 50% of the revenue handback, or it's trades, which is the other 50%. But what it doesn't do is account for the economics of segmentation. So by having a pretty cheap NBBO product, dart pools are actually able to use that and then effectively free ride off the prices of the whether it's market makers or an actual investor resting on the advertised quote. And so the people that are advertising quotes aren't actually doing the trades. A lot of dart pools get to actually benefit from being able to get pretty cheap data. You can, as a non-display vehicle in America, you can basically get a year's worth of all-you-can-eat data from the SIP for about $150,000. And these venues are doing trades worth billions of dollars. And so they effectively have a free ride off the price setting of the quotes from the market makers that are in the exchange advertised. But those market makers, again, are not capturing the spread for the value that they're receiving. So working out how much to actually accumulate, like how much that quote is worth, and maybe it's different for different participants. So in America, we do charge retail very differently than we charge professional eyeballs, which is different again than we charge the algorithmic, what we call non-display venues. But arguably still, and this comes back to one of the points raised, is like how do you structure it so that you make it more attractive to advertise quotes and then tighten that spread? And you don't create a problem where it's actually more attractive to start segmenting flow and trading off exchange using the quotes that are created on that SIP, which is relatively cheap.
So basically, the tape as a subsidy to investment bankers and market makers. Niels, is that what you would like to see from the tape in Europe? And what is the perfect tape that is a silver bullet?
No, I think it's a really important dimension and question to ask, right? I would always start with the observation, of course, that MiFID II, MiFIR, as currently implemented in the law, already has a consolidated tape in the text. Key question from our perspective is then, of course, to ask why no provider has emerged. And the clear reality on that end, and we can clearly out ourselves as one of the parties that has tried many years to establish a tape, is a problem around data quality, where the clear market failure sits. So if we want to approach some of the US investment banks operating large systemic internalizers, impossible to get their data, right? I mean, if these guys already fail in accurately reporting their data to the NCAs in the European Union, and the NCAs don't enforce the existing standards and the existing law, then we shouldn't sort of be surprised that there is no data available on these parts of the market, which is, of course, also interesting to observe, because that part of the market is intrinsically motivated because of conflicts of interest to remain intransparent. I think if we were to have data quality, and that's for me the important starting point, where I wholeheartedly support ESMA in being tasked to sort of define the standard quality, the standards going forward, and making sure the quality is there. I think that will be significantly superior to leaving it to an industry consortium, because I think that's pretty much how I sort of personally recollect the last 4 years, and that will not make a meaningful difference. I think then the second key point next to ensuring data quality is, of course, the coverage of the tape. We believe this should be 100% coverage of all of the EU market. That's the intention behind the tape. Otherwise, I can go to big market data vendors these days already and buy a tape, be it at Refinitiv or Bloomberg, where, of course, not 100% coverage of the EU market is being achieved, but a very large coverage already. I think 3-4 other elements for me are also critical in reminding everyone of, again, one is really make it cheap and fast to implement. We don't have the time now to spend another 5, 6, 7 years on a consolidated tape implementation, but it should be something that actually meaningfully supports Europe in this current challenge, also against the backdrop of the economic realities I mentioned in the beginning of our conversation. And that's also why I think in terms of concrete recommendations, we would suggest to definitely make sure that there is an appropriate sequencing. Right? We see this also in the deliberations on Council and EP side, where the added value as such should, of course, be much more meaningful on fixed income. Why so? Because the vast majority of the fixed income market remains intransparent. If we go for the outlook on an equities tape, then in particular, I think my main message is really avoid that pre-trade element. I think Phil has put forward quite a number of important illustrations as to what the US market has been suffering from structurally against the sort of backdrop of the pre-trade dimension. We shouldn't sort of be misled to assume that in Europe we could avoid gaming around the pre-trade tape. There will be much better informed investors and those that unfortunately are not that well informed, which of course leads to a strong discrimination between different market participants. But I would also clearly emphasize that in the absence of mandatory consumption, which is a clear integral element to the US tape, a pre-trade element in Europe would be disturbing to the extent that it would, by and large, create a question mark around how data contributors should actually be compensated for the contribution of data. That's why, concluding also on that end, my personal take is that starting with a 1-minute post-trade delay tape, including EBBO data, would actually be a meaningful starting point for Europe. This would be a tape that gives the ability to use it for quite a lot of different use cases, but in particular best execution verification. And I think once we have made our own European experience, or EU, I shall say, with such a tape, I think we can then also discuss next steps in terms of making it faster or expanding it into pre-trade if there is a need for that.
The one lesson I've already learned is that the next MIFIR panel will schedule for at least an hour and a half, because we're already 6 minutes over time. I would maybe give a final word to Alžbeta and then I'll sum up, because we're running late. I wanted to go into non-equity, but I think we'll skip that for this time. There'll be other opportunities to discuss that. Alžbeta.
Well, there is so much to say on what was said here. Maybe one more remark on dark trading and lit trading. It was very, very well mentioned by Professor Hübner that, and we have put as a presidency on the table more market or more data-based proposal. ESMA has immense amount of data. You know it, you report it. It costs you a lot. So we believe in a council that we should finally get into the time where we actually use this data rather than make a decision on level 1 or at a table with a crystal ball, and decide to actually propose to have more regulation on dark trading based on the data, based on the assessment and the data that it provided. But the question is whether this is acceptable or whether there is a requirement for rather cap on level 1, which seems to be also advocated by a number of member states. But the same goes for the deferrals, the same goes for a number of other issues. We have immense amount of data, and I think it's time to actually start using them rather than make decisions without them. And a consolidated tape, this is really a very heavy debate to summarize in a couple of minutes, but I can completely agree, and member states also agree that the fixed income is something that really needs a tape at first. So the council proposal, and I think the sequencing is already pretty much agreed upon, is the first one to actually being selected. Equity tape and ETF tape. I would say this is exactly the moment when we are trying to learn from US, but not really follow US. EU tape should never be used for trading. It's not a tradable tape. It's only for information. So only for information purposes, also because there always will be a delay based on the fact that Europe is geographically spread and the markets are in the various places. So it always be about information provided post-trade. Even if we include pre-trade, and the council is not apparently going in that way because there is a strong opposition on pre-trade, it will always be ex post, not usable for trading rather than for information and estimation on where the market is, where the liquidity is. And even though it might have its advantages, it was not in a council agreement that a pre-trade would be included. So far the council believes that maybe some pre-trade information and very limited information in a post-trade tape might be beneficial also, as President of Better Finance said, for the retail to actually see what is the spread, what is the best European spread at the market, to compare the trade that has happened and that was executed compared to what was EBBO at the time. There is a lot to say on the tape, but I probably will stop here.
No, I think we could go on all afternoon. You know, there's many facets, which I find interesting, that 1 year after the file has been published, so many issues are still open and are still being discussed. I think we had a fantastic panel to discuss it. I think Professor Hübner, with many years of experience in the Parliament and in the Commission, you, Alžbeta, I think having a very difficult job trying to find compromise in Council. Phil, obviously adding the perspective from the US, and I think knowing both sides of the Atlantic from market structure and the tape very well, and I think Niels being an expert of the European regulatory environment. But for me, maybe that is really the sum. We need to find the linkages, and I think that's always the debate in the US. That's maybe the thing that I miss a bit in Europe. And for me, as an economist, market structure comes first. Market structure determines what is permitted and what is not permitted. Who can do what is the level playing field. And a tape or payment for order flow are always things that come in second. And the best execution regime is also something that needs to be somehow linked in this. And I think I would encourage lawmakers to especially think about those links, because I think missing links in evolutional history are always problematic, but I think in markets they can be catastrophic. And that's why I think we need to be sure to get this right, that the constitution of markets in Europe is right. So with that, thank you very much, and a hand of applause for a really great panel. Very interesting, and I could go on for an hour.
Thank you.
Back to the second half of our conference on trading and listing, Unleash Europe's Capital Markets. I'm here, I think, with a very interesting fireside chat. We were just discussing, this is such a beautiful setting. The chimney would fit very much in the fireplace, but we will have to imagine the fire. But I think I have here two very good people to discuss with a little bit. What is it about getting the CMU really off ground? And with me I have Miroslav Kaczniewski. He's president and managing director of the Polish Association of Listed Companies, as well as Aurelian Namini. He's head of equity listing of Euronext, but he's also chairing the listing task force within FESE. And I maybe wanted to start to discuss, and just to set the scene, we've heard before that Europe's share of market cap globally has shrunk from, I think, the year 2000, where it was around 17% to 10% nowadays. We've heard recently both the French and German central bank have called there needs to be more completion of the CMU project. And capital market integration obviously will contribute to, I think, financial stability, geographical diversification of funding sources. It will strengthen the private sector, encourage risk sharing, and all the wonderful things that equity does. And obviously, in crises, we all know that equity is paramount to buffer exogenous shock. So the question, I think, how do we get CMU going? How do we get more supply of capital to European companies? And maybe the first round to my panelists, and Aurélien, I start with you. 10 trillion on bank accounts, not flowing into markets. What can we do to encourage that money to come onto capital markets?
Thank you, Rainer. So I'd share a few thoughts. I mean, if we want more capital to flow to European markets, we need to work on access to the market itself. We need to work on access to the products, the packaged products that allow for investments at all levels of sophistication of retail, obviously, institutional investors. And we need to make sure that information is transparent and relied upon by investors. So what I would say is, at Euronext, what we do, we're kind of a mini CMU, right? We consolidate 7 markets by now in Europe, on which 1,900 issuers are listed, representing close to 6 trillion euros of market capitalization. And what that does beyond the numbers is really to give completely seamless access to capital markets, to anyone, to European markets, to anyone who's connected to this platform, because behind the 7 venues we have, there's only one technology platform, one order book. So that's what we do in terms of working on access. And we think this is kind of our response to fragmentation, which is a topic that was talked upon about a lot. Then about information, I think there's a few things that can be improved. We welcome very much the work that's being done on the European Single Access Point, so that all investors can access public company information in one reliable place. In terms of the trading information, obviously we have talked about consolidated tape earlier. I don't want to redo the debate that happened. We think that most investors and retail investors would benefit from a 15-minute delayed post-trade tape, which would be sufficient to check their execution against market prices, and would be cheap and simple to implement.
Maybe to you, Miroslav. What do we need to do to get more supply of capital?
So I would say two things. One is more regulatory, the other practical one. The regulatory thing is that if you ask a question why retail investors are not coming to the market, I would say is that because it's too complicated to do so. Because in fact you can lose the savings of your lifetime within 5 clicks on your smartphone. But if you want to invest in shares or bonds or blue chip companies, you really have to pass examination for an investor. You have to undergo all of these suitability tests and so on and so on. So from a regulatory perspective, it's really very difficult to become an investor. Now, from the practical perspective, I think it's also very difficult because if you are talking about single access point, like Aurélien mentioned, well, within a few years we'll have single access point for, at least for information, ISAP, lecturing single access point, but this will be just a point of access to information, not to trading. And what I think the next step, or perhaps simultaneously, there should be some work undertaken to make sure that once we've got ISAP, we'll have the possibility to make trades. I mean, retail investors will have the possibility to make trades easily at very low or perhaps even at no cost. So as was mentioned in relation to Euronext, perhaps single access could be combined of all EU licensed exchanges. Because I think, well, for retail investor, let's say buying shares of SME listed here in Prague, it's really complicated, it's costly, it's time consuming, it's not something that could be done automatically. With ISAP and with exchanges having single access point for trading, I think it could be easy, and I think would have more demand, I mean, more supply of capital on the market.
So I think really probably a call to the EU Commission in its retail strategy to think about how to allow for pan-European access for the retailer, where it's very difficult still, and possibly tied to the ISAP. I think that's an interesting one. Maybe just to think about pensions, I mean, that if I personal history. When I was growing up in the US, people were discussing over the dinner table how to invest for their pensions. The 401k, extremely successful. In Sweden, they have auto-enrollment. Would that maybe be something like that, where we would have a pan-European pension plan? Well, we have the PEP, but it's not really being used. But what would maybe to enable pensions, what is sort of the key? Is it financial literacy? Is it having those kind of auto-enrollment models? How can we really get more pensions channeled into capital markets in Europe?
Well, so perhaps I'll start with the example of Poland, because some years ago we really had a lot of inflow of capital to the market coming from pension funds. And just a short warning that, well, sometimes if you have too much of that, then you'll have a problem. So now we have much smaller flow of capital coming from pension funds on the market, and this is really problematic because pension funds, who are supposed to be usual long-term investors, now they are becoming on the Polish market short-term investors because in fact they are rather selling than buying shares because in net terms they have negative capital flow. So less money they absorb from future pensioners than they have to pay to the system. And this is problematic. Obviously, in normally designed system, this shouldn't be like this, and normally, still more and more people should be paying their money to the system. I have no idea what to do to incline either regulatory or in practical terms the funds to invest more in capital market. Well, the first and the easiest way, but quite perhaps also complicated, is that they would earn money on this. So I would imagine that if the markets are growing, if the valuation of the companies are growing, then you would never have to ask anyone to come and buy shares. People and funds would come because they would like to earn the money. The problem is that over the last few years, we didn't have such an experience on the market.
Mm-hmm. So really to have an interesting product portfolio, and maybe, Aurélien, maybe for you to comment, how to mobilize pensions, what do you see sort of as key? Is it literacy? Is it auto-enrollment models? What is the...
I think the key. I mean, it's pensions, but it's retail incentives at large, right? You have schemes in France, for example, the PEA PME, which allows for a tax-free investment wrapper for retail into SMEs. You have also the PEA for larger corporations. And I think we lack a bit of a harmonized or at least a common philosophy in the approach on mobilizing retail capital into public equity markets through tax incentives. It's quite uneven between the countries, and we need more of those.
So also, I think a call for consideration in the retail strategy when the Commission is coming to that. Let's probably shift a bit on liquidity of EU markets, and we've heard earlier BioNTech, Spotify, Linde, they're going to the US for higher valuation and liquidity, and maybe what can we do to, I think, make EU markets more interesting for companies as well as for investors? I mean, what's sort of the thing?
So I think the key is to work on efficiency and scale. So that's what we are doing in terms of providing a deep liquid market for companies to raise capital on and for investors to invest on. Also, I think there's a work on perception. There's a lot of myth between US and EU markets. We see that a lot in listing when we speak to prospects, where there's a myth that they would get a higher valuation in the US. The reality is the higher valuation in the US is down to the nature of your business because capital flows freely. So if your business is based in the US, where it's simpler to scale your business, obviously your business is worth perhaps more than in Europe, where you have to work a bit through the different cultural and regulatory environments you're working on in the various countries you operate your business in. And I think there's an educational work that we are doing with founders and company executives to explain to them that listing in Europe is right for them, because when they list in Europe, they get ballpark, those are the numbers we see, about 60% of shareholders are European, 30% are American, and 10% are from the rest of the world. When they list in the US, they get 90% US investors and 10% rest of the world. What does that do when you manage a company? Well, basically you have either investors that understand the environment you operate in, or you have investors that sort of understand it from a US perspective, and so might be calling you to do things that are inadequate for your business. And that's sparing you all the details about the legal risks and the regulatory difficulties of being a European company listed in US markets. So.
Miroslav, liquidity.
Okay. So speaking from the perspective of smaller issuers from a smaller market, perhaps I would indicate that the discussion that we had just before and this chasing microseconds and so on is not the biggest problem of small issuers. It's rather a problem that you don't have liquidity at all, and in fact the biggest problems with small and medium enterprises is that they are not big. So once they are not big, in fact you cannot earn money on listing fees because they can't pay high listing fees, and you are not going to earn money on trading because there is no huge trading. And this kind of vicious circle that it's very, very difficult to change and think about that. And perhaps an idea would be free trading of such companies. I mean, I know it sounds quite strange. Who would pay for that? Well, we could find some sources of financing, but one of them could be that perhaps let's start some pilot program for selected companies. Tomorrow we'll have SME awards. Perhaps one of the awards should be the 5 years of free listing and trading, and we would verify if this changes anything, you know. We are in Prague, so let's check it, okay?
So maybe a reaction to that. So first on the issue of trading fees for retail companies, at Euronext what we do is we incentivize market makers to offer price improvements compared to the central limit order book for retail. It's called a best of book. So we encourage retail investors to invest in the market and offer them better pricing. As to your comment on listing fees, obviously for exchanges, if you segment the listing market, the SME market is very much a market where exchanges are central to the origination, because we participate a lot to educating founders, entrepreneurs, family businesses about the benefits of listing. This requires a lot of work on the ground. We invest heavily in technology to make the listing possible and attractive and efficient for those companies. We invest a lot in the regulatory framework, both in terms of engaging with policymakers, but also in making sure that our processes are efficient, are secure, are easy to understand for those companies. So I would doubt that a lot of investment would flow from our industry into covering these companies if there was absolutely no fees. I would just mention one number. For the smallest companies listed on Euronext, the annual fee currently is 3,000 euros. So I don't think the exchange fees are of any sort of importance.
So just to comment on that, if it's not important money, so let's get rid of this problem and let's just cut it to zero, because in my opinion, zero is quite a magic number. And if it's 0 or 0.007, it's huge difference. And similar discussion I've got with Warsaw Stock Exchange, that they are not going to cut the trading fees to zero, because they say, well, still anyway, if we cut the trading fees, the investment firms will increase their fees. I'll say, but once you cut it to zero, there is no possibility to do that, because you can advertise, well, this is free trading in these particular shares on this particular market. So I would really insist that zero versus non-zero is important, and if it's just 3,000 euros, so perhaps it's not important. And even from the perspective of the company, the listing fee is not a huge issue. But what we could say is the trading fees. So let's imagine that all EU investors, all the people who have these single access points, they have, well, on this market, on Euronext, or this segment of Euronext, I can trade for free. Well, I think this would be a change, really.
Well, maybe we discussed that a little bit in the panel before, payment for order flow, and if something is for free, you always need to be careful of conflict of interest. But I think, obviously, it's also important how ease of access and obviously cost play out at the end. Let's maybe move to a couple of more questions. Ecosystem. I would think, I always hear the ecosystems in the US are so much more attractive. Is that something that bothers your companies, Miroslav?
Well, now yes, but previously not. I mean, I would say that we used to be quite a center for raising money by SMEs. So very, very small companies are entering the market, or were entering the market. Just one number, the median capitalization of the company listed on the Warsaw Stock Exchange, the regulated market, is just 30 million euro. So these are really small and very, very small companies. They've entered the market because there was really quite an ecosystem for cheap and easy raising of capital. And once new regulations, new EU regulations came into force, which obviously they are good for the huge companies, once they've been introduced and imposed on small companies, they really killed the market. So over the last few years, we didn't have an IPOs because it became too costly, simply speaking. And I was even thinking about considering local markets like local food and so on. So you've got, you know, these exceptions that, well, for production of dairy, you have to undergo special procedures, but this is local cheese, so you can do it a different way. So perhaps it's just a local company offering securities to local people. Perhaps it should not undergo all the requirements. But at the moment, it's not the case.
Well, I think the next panel will discuss that a bit. But let me ask you, you did some research on SPOs especially, and I think cost and benefit of listing. And let's maybe touch on that briefly for the end of the fireside chat. I mean, if I look at that, why are not more people listing, and what is really the benefit, or what should be the benefit of listing?
So we've really undertaken quite a research on the Polish market on the costs of benefits of listing. Well, the huge costs of listing, they're really huge, and there are the costs of listing as fees to exchanges. This is really small, just 5-7%. So it's really not something important from the perspective of the company. There are other costs which are much higher. But what was shocking to me was really benefits or lack of benefits. I mean, the companies indicated they can't see any benefits coming from listing, even in financing their activities. So it was really surprising. And then it came to my mind that perhaps we should really create something, some benefit for listed companies. And this benefit could be possibility of raising money, of undertaking secondary public offering without prospectus. So obviously you have to prepare all of the information to the public so that the investors would know what they are buying, why, and so on and so on. But you wouldn't have to undergo the procedure of approval of prospectus by the NCA, which usually takes quite a lot of time. Usually you have no idea if it's going to take 3 months, 6 months, or a year, or whatever. So it would be really quick, fast, easy access to money by listed companies. And once they have such a benefit, I would really see that as something that would make their life easier than non-listed companies.
Maybe to you, benefit of listing. You're head of listing. What are you pitching? Why should companies come in, and what can we actually do to strengthen the demand side for capital, which I think is also part of the equation?
So I think the key, and I concur to some of your remarks, Miroslav, on the need for simplicity, but the key benefits, obviously, we all know, it's ease of access to capital, so obviously secondary public offerings are very, very important. It's also independence, because when we're talking about SMEs, the competition is not between exchanges, it's between exchanges and private equity, and we explain to founders and to company executives that when they list, they sell their own strategy to the market, who buys it or doesn't buy it and provides a price on it, but they remain in charge of defining the strategy. When a private equity fund comes into your capital, they come with a strategy for their own investors and they impose it on your company. Usually that's how it works, or some various shades of that concept. So those are the benefits that companies should be aware of. Obviously, there's the idea of having a currency for acquisition, of course, that is central. But of course, as Miroslav said, we need to make sure that the burden of being listed is controlled, so that complying to your ongoing obligation is ongoing regulatory obligations is not too burdensome, and that you can benefit from that. And we completely agree with you that as long as a company is listed and complies with all the ongoing obligations, we should try and have as much as possible waivers on prospectus issuance when companies are issuing follow-on capital.
Well, I mean, to sum up, time's flying fast today. I think a lot to be done on CMU. I think strengthening the supply side, if I really look at pensions, if I look how to enable retail, how to unlock, I think, the 1 trillion on accounts for investing into the capital market, but also really on the demand side of capital, obviously a lot to improve the ecosystem. I think this is what we're going to discuss in the next panel, how to unlock IPOs in Europe. And with that, I say thank you very much for both of you. I think it was very interesting. And the solutions we'll hear now.
Thank you, Rainer.
Good afternoon, ladies and gentlemen. Following the fireside chat, I think we had an excellent introduction to this panel, and I'm very happy to moderate the last panel of this FESE conference, which will be dedicated to discuss how to unlock IPOs in Europe. I'm pleased to be joined by an excellent group of speakers, and I would like to introduce them right now. So next to me in the room, we have André Kovarik, member of the European Parliament from the Econ Committee. So we are home to your constituency. I'm very happy to be here in Prague. We also have Álvaro Castro, head of equity primary markets from SIX Group, BME. And also we have with us Vladimir Jarosz, CEO of Good & Company. And I want to especially thank Vladimir for being here with us today, because this has been a last-minute change in the program, because unfortunately our initial speaker from your company, your colleague Jan Sikora, unfortunately is in COVID isolation today. So we're very happy that Vladimir could really come that quickly. And then from the screen, joining us on remote, we have Tanya Panova, head of unit at the Capital Markets Union in DG FISMA from the European Commission. And also we have with us Adam Kostial, Senior Vice President, Head of European Listings at NASDAQ. So before starting the debate, I would like to make a few introductions, even though, as I said, we had an excellent intro with the fireside chat. But we heard precisely that we need to trigger more demand from companies and investors to enter the market. And I want to begin with saying that EU companies are not yet making the most of the funding potential that our capital markets could offer. In fact, we recently heard and we saw a joint statement from the heads of the French and German central banks that were stressing the need for the completion of the capital markets union. The digital and the sustainable green transformation of our economies, which are just now is a reality, will have to be financed by capital markets. So we absolutely need to get ready, and as we call it, we need to grow the pie. The reality, in contrast, shows that EU's capital markets are not growing enough when we look at the indicators such as market capitalization, number of listed companies, venture capital funding. So this is something that is a little bit worrying and does not really show a rosy picture of our reality. And in fact, if we look at some CMU KPIs, just to really measure this reality, the slow progress in our competitiveness is reflected in the declining proportion of our global equity market capitalization of listed shares. And in fact, if I quote a few numbers, we can see that, in fact, Rainer also mentioned that. I'm going to repeat just the figure, but I think in the last 20 years, we've gone from 18% to half, almost 10% of global market cap in listed companies. And of course, this reality is due to several components. It will be easier if we just had one reason for that. There is obviously the ongoing trend of company delisting. It was mentioned several times, the reality of Linde from the DAX now going into NYSE. But also we have the reality of fewer IPOs coming into our markets. And in fact, their numbers are quite worrying. If I quote the statistics, from the period 2000 to 2006, we had about 370 annual average of IPOs coming, while we are just only expecting about 100 in this year, 2022. On top, I don't want to sound too negative, but on top we do have capital markets, as discussed earlier, that remain too fragmented, that are too costly, and still too small to really properly support an economy of our size. But okay, we need to kind of look positively on what to do, and we also need to kind of set vision on what are the goals of where we want to go. And one of the things that at FESE we have been advocating is to set the bar high when it comes to market capitalization in terms of percentage of the union's GDP. And we were calling to reach the 100%. We heard earlier in the previous panel that we are quite below that number, but definitely this is not unachievable, and we all call to try to reach that objective. Okay, so just now to conclude my intro, I think there is no choice but to support public markets and improve this IPO environment and ecosystem for all the companies. So I would like to discuss with our distinguished panelists how to do it better, and in particular I would like to structure the discussion in somehow 3 blocks. First, to look at what are the current trends of this SME equity funding. Then obviously we need to look at the obstacles, the difficulties that we are facing, probably also learning from others that are doing better, and to end up with what are the solutions. And obviously we have the awaited Listing Act legislative proposal, which is coming in a week time, if everything goes well. And obviously that will be a very good wrap-up for our panel. So if I start then looking at the current trends, I would like first to give the floor to Tania Panova. Tania has been leading the CMU unit already for a number of years. She has been driving the work, and I know, and I need to also say publicly, the intellectual investment that she and her team have put into that. They did this CMU high-level forum that ended up, after all, with a CMU action plan and really put some measures there. So I would like, Tania, if you could give us an overview of the objectives and plan actions that you have in this action plan, just a bit of an overview on where do we stand, what still needs to be completed, and also with a special look at SMEs.
Thank you very much, Rosa. I hope you can hear me.
Yes, we do.
There is a bit of an echo, but I hope that's manageable. So maybe I can start on a positive note, a slightly more positive, and maybe a bit contradict what you said, Rosa, in your introductory remarks. So you've painted a fairly bleak picture for this year, and you're absolutely right. This year is a difficult year for many reasons, and many of these reasons are outside our control and the control of stakeholders. What we have today is, probably something that we didn't expect that we would be having when we first were embarking on the CMU action plan back in 2019 with the HLR forum. And if we actually look at the last year's numbers, including last year's numbers on initial public offerings, I think the year was actually quite good, and we were all quite happy also in the post-COVID situation, seeing such a good recovery for the markets and number of companies coming to public markets. So I perhaps wouldn't be as negative as you were in describing the current situation, because the current situation is driven by many factors, and most of those factors are political or ramifications of political decisions or political developments. Now, where do we stand on the CMU action plan? And thank you very much for the praise. We are looking potentially at 2/3 or even 4/5 of the measures being completed at the EU side, and that is counting the upcoming new CMU package of measures that you've anticipated or pre-announced, that is likely to come in a week time or so, where we will put forward 3 packages of measures focusing on corporate insolvency, listing rules, and rules for clearing. But I will get to that point in a second. So among the measures that we have already tabled, and I would like to emphasize that, of course, here is the focus is on the emphasis is on tabled, because the work doesn't stop there, and the progress of many of those files has been rather different, if I may say so, in Council and Parliament, and I'll get to that point in a second as well. Among the measures that we have tabled, where the Commission tabled a legislative proposal, the majority of the measures are in the area of access to finance. To name a few, and I think the previous speakers did mention the ASEP proposal, so on the single access point, there's been an ALTIF proposal, looking more at the vehicles for investing in SMEs. There have been also elements that we've taken on board in the CRD review, Solvency II review, as well as some other non-legislative measures that we have been working on. Progress on the second pillar of plan, which largely focused on retail investor participation, where the objective of the CMU action plan was to put forward measures to ensure to underpin a safe environment for retail investors to save and invest in the EU. There we're currently working on what we call a future retail investment strategy that will come next year, and where most of the measures focus on rather non-legislative actions that we've taken so far, notably in the area of pensions for many reasons. Also part of those reasons are the lack of competence for the EU, but also financial literacy. So the objective that we are pursuing there is really to bring retail investors to the markets, to nudge them into investing, but a lot of those measures so far proposed are of non-legislative nature. And finally, the last pillar, the last objective of measures focuses on market integration, and there we will be tabling a proposal on corporate insolvency law in a week's time, and hopefully there will be another proposal tackling one of the key cross-border investment barriers, such as withholding tax. So all in all, I think in terms of the Commission delivery, we're almost there, also counting the measures that will be adopted next year. I therefore do not have any worries on that front. Where I do worry is, however, how the co-legislators will take those proposals forward, and whether we will have an agreement, a political agreement, on all of the proposals in due time, i.e. before the change of the Parliament, before the new legislature, to ensure that those actions can be enacted as quickly as possible. And there I would call on, and I know we have been working very closely with Andre, and his contribution into the ALTIF agreement is noteworthy. So I would like to thank him for reaching a quick agreement on ALTIFs. But a lot more work is necessary, and we're still lacking the Parliament's position on a number of essential key files, including MiFIR review and ASEP, where I think we don't have yet the Parliament's negotiating position.
Thank you very much, Tanya. No, and indeed, this is a collaboration. I mean, this is not just the Commission, as you said, putting a good number of legislative proposals forward, but is also negotiating them, and as well as market participants buying into them. No, and this is something that has always been said by some of the policymakers about the Capital Markets Union. So now, turning to André, a member of European Parliament, you have been alluded, right, as a co-legislator. We do have an EU open strategic autonomy in plan. We also obviously have the idea, the project to develop an equity culture in Europe. And concretely, already before COVID time, Econ set up a working group on access to finance for SMEs. This is something that also Tanya referred to. So, André, could you please elaborate a little bit on the work that this Access to Finance Task Force has been doing so far, and what is your perspective into the Capital Markets Union Action Plan as Tanya was outlining?
Thank you very much. Thank you, Rosa, and thank you for the invitation. It's actually a great honor.
to be able to speak to you in Prague. And I think a lot of things were said here. First of all, just to sort of come back to what Tanya has just said, and obviously a big thanks for the cooperation that we're having with the European Commission. With the, let's say, the first generation of the CMU action or CMU initiative, we sort of seen that there was definitely not achieved what we expected. And I think with the idea of establishing high-level group, really, putting together the action plan and going with concrete actions forward, I think that actually made the difference and helped things to move forward. I think if you ask me from the European Parliament's perspective on the support on CMU, in general, if you ask members of the European Parliament whether they support it, in general they would say yes. Yeah, but I think that's the only consensus that we have. Then I think the many differences come when we discuss the concrete proposals and the positions towards them. And I think that's one thing. And the other thing, and I just realized that when we were discussing the current environment, I think we also have to be cautious about sort of a consistency or policy coherence that we have on the European level. Because in terms of, for instance, the CMU action plan, and the related activities, there is a very good consistency. But if we look beyond that, for instance, the question of listing or not listing in the European Union, we're currently discussing quite tough reporting measures in terms of due diligence, in terms of sustainability reporting. I think very good proposals, but very often you hear, oh, it's okay, it's only for listed companies. And then, then the argument is, okay, so then it's only for listed companies and it's fine. But actually, then these requirements can be quite burdensome for those listed companies. So I think we have to look into the complexity of the regulatory framework that we are putting forward. And even if we have very good intentions, that we have to have a sort of very good impact assessment to see whether we are not actually causing some other problems or some harm, and I think we will have the same possibly the same situation. Tanya mentioned the current discussion on the capital requirements regulation. Obviously, we will have to implement the Basel III rules, which will make lives of banks a bit harder. Again, is it for good in terms of access to finance for companies? For bank finance, it's hard to say. Maybe it can actually, again, create some problems. And hence, I think the more importance given to the idea of developing through a capital markets union in Europe. You mentioned the working group. We have established that particular informal working group under the Econ Committee, so the Economic and Monetary Affairs Committee of the European Parliament. It was initiated by our political group, by my colleagues, myself. I'm actually chairing that group, and the idea was actually to highlight the specific issue of access to finance, because we discuss the SME agenda and in the broader how to establish working business environment in Europe horizontally, but very often we end up in one specific problem, and that is actually lack of access to finance. So we can have very good initiatives in other areas, but if the financing is actually lacking, then we may have troubles going forward. And the idea was to create a platform where we had actually Tanya and her team taking part in the exchanges, just to give more time and space for the members of the parliament to discuss with stakeholders, but also with other institutions. We often organize exchanges with presidencies to give also or to get some insights from the council, and have this as an informal platform for exchange of views on some specific points closely related to access to finance for SMEs. And I think we had some good presentations also from the Commission on the upcoming proposals. We are definitely looking forward to them. But as Tanya mentioned, we may have issues in terms of moving quickly enough. I think there is a number of colleagues who have this sense of urgency to deliver on those proposals. But as we see, for instance, For the specific case of the MiFIR revision, it takes quite time. The same, I'm working on one of the opinions on the single access point. We are discussing details which I think are not very relevant in terms of data quality and et cetera, et cetera. I think, you know, we should really be moving forward, and I think that's also, in my view, fully valid for the upcoming proposals, especially those that will be published before the end of this year, because I think there is still enough time to deliver in terms of positions, both from the Parliament and for the Council. But I'm myself looking forward to, especially next year, for the retail investment strategy, because I think this, in my view, is one part that is definitely missing, and we need to have a clear strategy on the European level on this specific point. And I think there will be a lot of interest also on this particular proposal from the European Commission. So we are very much looking forward to the discussions, not only among the institutions but also with stakeholders, because I think that can be a critical point on the CMU agenda before the end of this mandate.
Absolutely. Thank you very much, Andre, for all these thoughtful remarks, because as you said, no, in terms of coherence, is not only the listed versus not listed, as you said, is the retail link to the CMU. In fact, earlier, Rainer mentioned this 10 trillion euros that, you know, households have in deposits. This needs to be really supplied into the markets, but also is this reality that indeed the banking sector might be struggling a little bit in the sense of, you know, all these capital requirements that they will have to now follow, which really opens more the opportunity for capital markets. So now I would like to turn to market practitioners, and they can explain to us, hopefully from a business perspective, how things are looking into this SME equity funding. So, Álvaro, what is your experience on this trend in equity funding, in particular on SMEs? I'm more interested now. Obviously looking at Spain, because you are really running the Spanish market. So what can you tell us about that?
Okay, thank you very much and good afternoon. Thank you very much for giving us the opportunity to be here with you and discuss about this. Well, the global trend, you said it before in your introduction, the global trend, long-term trend in the last 10 to 15 years is clearly decreasing. Not only in SMEs, but also in main markets. For example, in the Spanish main market last year, we had only 3 IPOs. Although, if we have a look at 2021 and 2022, those were really, 2021 wasn't that bad. I mean, 2021, there was an optimism current in the markets, the post-pandemic optimism, the entrepreneurs and everyone, the economic was getting good. So it was a really, if we think about private equity markets, it was a record year with private equity, with venture capital, and with business angels investments in a record year. No? So it was really good year for private equity. And as I said, in public equity and in BME in Spain, we had in 2021 3 IPOs of big companies in the main market. So that is good news. Coming from we were coming, no? So that was good news. But if we focus on SME, on our SME growth market, which is BME growth, we weren't very creative in the name. It's a BME growth market. It was especially a good year, 2021. We had 16 IPOs, so that's a good number. And these 16 companies could manage to raise more than 1,000 million euros. So that was a great number. Not only these 16 new companies, but also the companies already listed. So it was approximately 1,000 million euros raised by these SMEs listed in our growth market. And then 2022, well, there were some measures that already were anticipating that something was going to happen in 2022, not the war, but other things, economically speaking. Then the problems in the global supply chain, the raising in energy prices, and then inflationary pressure, and then monetary restrictive monetary measures and capital, interest raising. So it was really a big problem in 2022, and all this became or produced that all that trend of new IPOs was suddenly or sharply stopped. No, so that was in the main market, in our main market. In 2022, we've just had in Spain one IPO in the main market, but surprisingly, in our SME growth market, things are quite good. I mean, we have already had 11 new companies, new IPOs in our BME growth market, and we are expecting to have 5 more before the year end, because they are concluding their process of incorporation and whatever. So we are going to reach again 16 new companies in our SME growth market. It's the same number as in 2021. So the trend is the same, is increasing. The number of companies that are evaluating incorporating into our SME growth market as a way to finance their growth. No, so I think this is a result of the Capital Markets Union Action Plan. It's giving some fruit. It's bearing some fruit. Companies are more and more interested, or SMEs are more and more interested in going public, and we hope, or I guess, is a quite a best moment for giving a new impulse to this CMU action plan. So, well, this is the trend, and we hope for the next year the trend continues and more SMEs are coming. No?
Well, that's very, very good to hear, Alvaro, I must say, and it's very encouraging to see that despite the circumstances, etc., the trend seems to be kind of going up, and indeed we had an extraordinary 2021 year, but I think we should not measure only that. I mean, I was my introduction referring more to the global trends in the last decades. But it's good to hear that the growth markets are kind of now taking off a bit. Because one thing that is very important is that a well-functioning IPO market is also critical in the pre-IPO environment, because that impacts on the exit strategies and therefore the provision of risk capital by venture capital firms. So now I would like to turn to Vladimir, because you have contributed to shape the markets in the CE region through your company. So any reflections on what has been discussed so far, and what is your opinion about this topic on equity financing?
Wood & Company represents, for the last 30 years, this region. So we happen to have headquarters in Prague, where we trade across the all markets in Central Eastern Europe, but also the emerging and frontier markets. So we go as far as Baltics and former Yugoslavia and Greece and Turkey and the satellite Russian countries. Just done an ABB for a Georgian bank last week. So we try to sort of race. We all do go for this fragmented, neglected, smaller markets. in Prague, where we are, that's our home, we are of course a little bit deeper, so we go even down to SMEs but in other markets we operate in this sort of mid-cap sector, let's say. Large caps are disappearing to the US. That's happening for all, whether it's Western, Eastern Europe, frontier, whatever. Whoever breaches a couple of billions tries to go, they're escaping Europe and they're running away from us. Mid-sized companies, from capital markets perspective, they tend to be listed in Europe occasionally. They have a clientele, and that's our main sort of, let's say, bread and butter for our business. And then we have these small cap or SMEs from the European regulatory, whatever, which the stock exchanges created various smaller market segments, including Prague Stock Exchange. Peter's created this this beautiful start program where we sort of listed a couple of companies, and we're going like where we're a smaller economy than Spain, where we're following the same food path. And last year we raised the first SPAC for this region and listed it on the Prague Stock Exchange, and we're in the process of finding the right targets to promote and pre-raised. It's a slightly different way than private equity funding. So we pre-raised capital and offered that the SPAC to whoever is the entrepreneur who wants to be merged and go for, let's say, public market without giving away control to private equity or strategic, but wants to just to take the cash and deal with the public markets investors. And that's our hope, that we will sooner or later sort of convince more entrepreneurs. This year is a disaster, of course, because of the war, not so much because of the regulation, but the regulation doesn't help us. I mean, sometimes if I have a chance to speak to regulators, if you're thinking about regulating more, just think about regulating less. Because my life is complicated enough as an investment banker. My life is complicated enough because we need to match the greed of investors with the greed of issuers and find a match. And then, of course, comply with all the regulations which are imposed to us as intermediary brokers, just to make sure that we sort of follow the documentation if we want to sell, that we sort of comply with all the regulatory. I mean, I'm funding quite a substantial legal departments, as all investment banks are and are required to do, and that's and the amount of regulation is not decreasing; it keeps increasing almost exponentially, and we're still taking a small margin on currently depressed markets. We survived the COVID downturn. We have the same recovery as you did in Spain in 2021. Entered 22, January, February was good, and now we had the wall again. and so we try to survive on the small deals. The local market still works because there's so much of local money being raised. So far, temporary deposit for high interest rate are waiting to be deployed to the market. So that's we work on the small issues, but the mid issues disappear. And the big issues disappear as well, because if they are happening, they go to the American banks and American stock exchanges. So we are left with sort of local issues and local bond issues. That's what we try to survive and survive too for the next year. We have quite a lot of work, so all the issuers are asking us to work. So we're getting tons of RFPs and we're submitting pitches, and we are mandated for several IPOs. But whether they will happen in the first quarter or not, that's to be seen, because still there is this instability of the prices, and equity issuers don't want to necessarily sell their shares for 30% discount to the market, because they have in their heads the valuations a year ago, and the debt issuers don't want to raise money at 10% interest rates, which is the current rate in the local marketplace. So they kind of keep delaying and delaying the issues, while I'm still running the cost base of the investment bank.
Thank you, Vladimir, for your reflections. And indeed, I think it's quite clear that there are lots of challenges, and these are not easy times. But I would like now to turn to Adam from NASDAQ, because I think it's agreed by everyone. I don't want to offend any other market, but that the Swedish model seems to be the first in class in terms of integration of capital markets, but also how much they are raising capital, their companies, but also how much investors, how many investors are really contributing into the capital market. So, Adam, I would like to ask you, in fact, also from your NASDAQ US perspective, why is Europe lagging behind the US? What, in your opinion, will be like the main points to explain that reality? And what do you think that are measures that will have to be developed in the rest of the European Union to somehow learn from the success that you have in Sweden?
Well, first of all, thanks for allowing me to join this panel, and sorry for not being there. My colleague Arja Retsen is there in Prague, so she will be glad to share more expertise around our markets. Well, of course, your question is a question we're trying to solve years and years and years. So I'm not sure I have the answers in 2 minutes here. But I think from our perspective, we're, of course, very humbled to have such a great ecosystem that we have from an SME perspective in the Nordics. So far this year, we have listed 60 companies. We've had close to 40 IPOs. 35 on our First North market and 5 on our main market. And that compares to 200 companies last year. And of course, we look at all listings. I think it's important for us not to look at it only from a perspective of IPOs only, but also for, fundamentally how are companies accessing markets. So if companies are now doing reverse takeovers or leveraging the SPAC structure or listing without raising capital, each company accessing the market is equally important. And of course, doing a larger IPO in this very, very volatile market is more complex. And we're seeing that in the US as well. I mean, US is lacking IPO momentum right now, and this is a global issue, not a European issue. I think the fundamental reason why we continue to see smaller mid-size IPOs, which I'm very proud of, is we have been very committed to a growth market. Not only us as an exchange, but our economy has been committed. Our government has supported it with good, clear infrastructure support from ISK, independent saving accounts, good tax structures, etc. Of course, it can always improve, but overall, it's become a very favorable and manageable infrastructure for SMEs and also for retail inclusion. The larger IPOs are the challenge, and I think what we are focusing on is, last year we had 40 companies going to the US from Europe, either primary or dual listing. The year before, it's 20 companies. It's not 20 companies we're talking about here that are the problem. It's fundamentally about how do we create a good infrastructure to support larger IPOs when they come back to market. And it's not only, so from our perspective, it's really about making sure that we have more expertise and more knowledge in terms of being able to assess and take on the risk that a lot of these growth companies mean, because a lot of these growth companies are coming from sectors which are fundamental in a shift that we need to take as a society, whether it's a clean energy shift or whether it's a digitalization shift, etc. And if we're expecting the US to fund the shift, then that becomes a concern. I think from our perspective, at the end of the day, large companies will always have many options. Smaller companies have less options. And we need to make sure that the public markets is accessible and manageable for smaller companies. And smaller companies grow. We have a great example now of a company that listed with us at 150 million euro valuation and is now graduating to the main market from our First North platform at a valuation of roughly 8 billion euros. And last year they raised roughly 700 million euros on our growth market. These are the success stories that we need to address, because if we don't raise the companies if we don't list the companies at 150 million euros, they will grow elsewhere and they will have other options and they will potentially be acquired. So we need to make the smaller growth market accessible, manageable, in a transparent and clear way, with trust from all sides involved. It's not about reducing complexity in the sense of just making it easy, making it cheaper at zero cost. It's really about making sure that the ecosystem is a trustworthy ecosystem, credible, but then again, we shouldn't be over-regulating it. And there are many pockets of over-regulation which are creating complexity and creating an uncertainty. And when we have more volatile markets like this, then they don't want to take on that uncertainty. And I like the comment about that we should not always be regulating listed companies. It's equally important to regulate unlisted companies, because there are so many options for the unlisted companies today, and we need to make the public environment more attractive. So from my perspective, there was also a comment earlier about that the markets are global and globally accessible by all investors. That's not really true, because the one issue that you have is that you can attract a certain layer of US investors to support growth companies here in Europe. And Adyen is a great example in Amsterdam. But the reality is that we do not have these $10 billion Oklahoma funds or technology funds in Oklahoma, and they will not invest globally. They will try to convince the companies to list in the US to de-risk that investment. And that's really what we're seeing as a peer pressure, or as a pressure for some of these European companies to access the US. Again, very complex topic. We could spend hours talking about this, but it's great to see that we have a listing act coming out, which hopefully will address many of these, because we need to be focused on investing in growth markets and willing to take on the risk of investing in growth markets, because that risk will be a return of investment for many.
Thank you very much, Adam, for your reflections, because indeed, I mean, as I said at the beginning, this is a very complex topic that it will be much easier if it was just one problem, one solution, but no, there are many angles to it, and indeed, I think you pointed to a very important question. It is how to keep the companies, remaining in our market. So one of the aspects, in fact, that makes me now link to the next idea is on the coverage of the markets, on the companies, coverage of companies. In fact, about this equity research that we saw that unintentionally there has been an impact with the unbundling measures. And I think it's quite important that not only liquid blue chips are looked at with care, but also the SMEs, because precisely these are the ones that, as Álvaro in fact was saying, that are the ones now coming into the market, etc. So, in fact, from the Spanish perspective, how do you see that topic in terms of the equity research going? And I think you have an example also to elaborate from there. So if you can take the floor.
Yeah, thank you. Well, this is one of the obstacles, really, no? It's, well, some of them, we have already talked about them. But one of the obstacles of the growth markets or SME growth markets is their low capacity of giving visibility to SMEs comparing with the larger companies or the companies traded in main markets, no? And one of the solutions should be, or the problem is the lack of equity research coverage for a lot of or most of the companies. Well, talking about figures and talking about Spain, like 4 years ago, more or less 40%, 42% of the small companies traded in Spain, in the main market and in our growth market, were what we call orphan companies. Orphan companies is those companies that they don't have any research coverage at all, no? That was 42% of the small companies traded, listed in Spain. And if we have a look, or if we look only at our BME growth, SME growth market, this percentage is or rises up to 70% of the companies 4 years ago in our SME growth market were orphan companies, that's what we call them. So we tackle this issue and we try to find a solution. And what we did is to launch an initiative in collaboration with the Spanish Institute of Financial Analysts. The initiative was called, or the project, well, it's not a project, now it is a reality, it's called Lighthouse. And the aim was to give light, or to put the focus, or try to give some more visibility on the small companies, giving them access, cheap access and easy access to equity research, coverage. So a group or a team of analysts in this Spanish analyst was or started to give this coverage, and now they are following and issuing informs or reports, coverage reports for more than 30 companies, 30 small companies, listed companies that were orphan before. And this means that the percentage, 42% now, is 27% of orphan companies. They expect to have more than 40 companies in a year. So at the end of 2023, they will be issuing reports and giving research for more than 40 companies that used to be orphan before, no? So this will reduce the percentage until 27% of the companies in Spain, no? So this is the Lighthouse project. This is just an example on how things can be done in this area of equity research coverage and trying to solve this main obstacle, which is the low capacity of growth markets to give more visibility to SMEs. And also, Adam was saying to give more visibility to this exit. To these companies that can jump from the small company, so from the SME market, growth market, and jump to the main market and grow. And because we have also 2 or 3 big examples in Spain of companies that were included 5-6 years ago in our SME growth market with a 16 million market cap, and then they reached the IBEX 35 with more than 3,000 million market cap. No? So we have also to improve our capacity to give visibility to these companies also.
Yeah, no, absolutely, Álvaro, and I think it's very good to hear about this initiative, Lighthouse, to at least for those that were not familiar with it, because may serve as an inspiration, right, on how also proactive action from private sector can help into getting not only the visibility to companies, but also to the brokers that in fact are the very important intermediaries in this ecosystem. Now, also turning to André and talking about initiatives, Renew Group, your political group in European Parliament, has established a dedicated SME task force recently, and I understand this precisely to look at how SMEs can access to finance, and I will understand that obviously as part of it could be as well how they can benefit from capital markets. So can you maybe elaborate a bit on that task force? What have you analyzed or assessed so far with regards to obstacles, and what is a little bit the timeline of your work there?
Yes, thank you. Indeed, yet another parliamentary platform that we pioneered as a political group, because we obviously have the issue of SMEs in our heart as liberal political group. I think we should be those standing for businesses in the European Parliament. I think the overall idea is actually to put together the members of the European Parliament from our political group that are sitting in different committees. And I think this is linked to the comment that I had earlier on the policy consistency and the coherence. So if we work on a specific piece of legislation, and there's a lot of them that are actually going to many committees horizontally, so that we are actually aware of what various committees are doing, that we can actually put forward the same ideas, the same amendments even, and actually make sure that through the activities in those committees we can help to shape the regulation in a way that can help or at least harm least. Depends on the point of view, right? It can be less harm or more benefits for SMEs, and I think that's the very idea. We actually have, as we speak, we have a delegation here today in Prague, because there is an SME assembly organized by the European Commission that kicks off tomorrow. So we are the only political group represented as such through our SME task force in Prague today, and actually I hope we already had discussions with the Chamber of Commerce, and we will meet with our stakeholders. I really hope that this can actually also fuel our the work of our task force. Obviously, the idea of actually working on access to finance issue is one of the, let's say, the key areas of interest. We are impatiently waiting for the proposals from the Commission. Hopefully next year, as you mentioned, the Listing Act that may help in this regard. But I think also an issue of corporate insolvency and other issues. And as I mentioned in the first part, definitely the retail investment strategy, because obviously this, in my view, would be definitely this horizontal initiative that would require many involvement of many stakeholders. And I think as our group is actually already working on some of the issues, we managed to conclude the negotiations together with the Czech presidency on European long-term investment funds. I think also an important step forward. Let's see whether this can be an important addition also to development of capital markets. But I think not only those, let's say, concrete proposals, but I think more broader policy initiatives. And I think in this regard, this also sort of, in my view, converge with the plan of the European Commission, but also work on creating and helping to create the investment environment in Europe. We mentioned the issue of financial literacy. I think that is very much important, also from let's say from the point of retail investors. But in my view, it's also an important area to cover with regards to entrepreneurs, because actually there's a lot of business owners that are actually very much focused only on one, let's say, source of financing, as we see in Europe. And I think the idea should be also to broaden very much the horizons for entrepreneurs to actually look into other options. And I think these two things should go sort of hand in hand to create, not only to create the investors cultures in Europe, but also sort of to create the demand from the businesses. I'm not saying it's not existing. I think it's more about, you know, broaden it and actually raise awareness in this regard. So I think it's also this combination of legislative but also non-legislative, more like broader European policy actions that should be brought forward, maybe with no immediate impact, but with definitely long-term impact to be seen in this regard.
Thank you, Andre. And indeed, you also mentioned the fact that the SME Week will kick off today, in fact, here in Prague, under the Czech presidency. And we are very pleased, obviously, to also be part as FESE of this. As you were mentioning, your group is here as well. And now I would like to turn to the Commission, because as you also mentioned, Andre, we are all kind of looking forward to see the Listing Act coming. But before moving there, Tanya, I have another question, which is now that you just listened to the debate on the obstacles, did you get the same feedback in your public consultation, the one that you closed in February? And what have been the areas that you had to focus in your impact assessment? Of course, I understand that you may not be able to disclose as much as we would like, but I'm confident that you will be able to kind of give us some of the interesting remarks here.
Sure, Rosa. So I think the fact that probably most of the parties that represented in this panel responded to our public conference in a way is an indication that here we have today a good representative sample of the respondents, and hence it's not surprising that most of the things that have been mentioned by the speakers in today's panel were also reflected in responses. Now, how I would like to start, however, is perhaps with a bit of general statement, or actually the starting point. When we looked at this project, and when we started this project, we looked also and tried to go through as many existing studies and research. And what we've concluded, but also having spoken to many stakeholders, is that the decision to list is a very complex one. There is, and I think Rosa, but also some of the speakers mentioned that it's never as simple as you change the rule, you remove certain rule, or you replace it with another rule, and all of a sudden you have many IPOs in the EU. It's much more complex than that. And I think responses to the public consultation largely reflected this picture. So when we asked the question, do you think that regulation is the biggest obstacle? Some of the respondents indeed said that yes, but many did mention, for example, lack of liquidity on trading venues. The fact that there is insufficient institutional investor demand has been mentioned as one of an important reasons, important factors why companies do not list in Europe. Now, while about 70% of the respondents said that overall the legislative setting was sufficiently well developed to address the issues of investor protection, many did say that perhaps it requires some fine-tuning because it was not deemed as sufficiently well designed to solicit sufficient interest from institutional investors or even retail investors for that matter, or to allow companies to have an unimpeded access to financing. So I think in that respect, the results of the public consultation very much were aligned with what the speakers today mentioned as some of the key reasons. What we also heard during the public consultation is that a lot of the cost, some of the cost is of regulatory nature, or the nature of the type which result due to the need to comply with the regulatory requirements. Many participants did mention the fact that there are lots of fees from intermediaries for example, that represent a substantial fraction of the overall cost related to listing. So many mentioned bank commissions, advisors fees, legal advisors fees, those consultants that and banks, investment banks that help to build the book, to prepare the transaction. So those were mentioned as important cost factors. Now, of course, as the Commission, we unless we want to price regulate, and personally, I'm not a great fan of price regulation. It's very difficult to influence those factors. So we decide to focus on things that we can change, and what we can change, we can adjust legislation. That ultimately we're behind, right? Together with co-legislators, obviously. So this is where we focused our efforts in the Listing Act. So what we are focusing on, and of course I don't want to reveal the details, but a lot of focus is on the primary issuance, on first-time issuances. How do we bring people to the market? How do we create incentives for people to come to the market? And of course, what are the disincentives today for people not to come to the market? So we are looking at the existing prospectus rules, first-time issuance prospectuses, both in regulated markets, but also SME growth markets. We are also critically looking at cases when securities are already admitted to trading, and a lot of information is already available in the public domain. To which extent having a prospectus is relevant, how much of the information can already be relied on, what is the additional information that is not there and that would be necessary for investor to form a decision to invest or not to invest. So it's a bit of a balancing act, because what we need is, and I think Rosa, you did mention that, we need to build trust. So we cannot, and somebody did mention, you cannot, I think Adam, maybe you did, deregulate at any cost. This is not the objective, and this can never be the objective of regulators. What we are seeking here is to strike the right balance. The balance between investor protection, and the majority of the stakeholders responding to the public consultation said, okay, current legislation is fit for the objective to ensure adequate investor protection. Now, whether this objective is reached at the lowest possible cost for other stakeholders, this is the question that we asked ourselves. Can we reduce the burden on issues while not impairing investor protection or market integrity? So this is an important consideration that we've considered. We've also looked at the transitioning. When you transition, and some speakers did mention that, what happens when you transition from SME growth market to regulated markets. Of course, the primary consideration for us is to ensure that rules apply to all entities in the same way on the same type of trading venue. So we're not trying to introduce fragmentation in rules for companies of different size that are listed on the same trading venue. So this is still our overarching consideration. We're also looking at governance structures. So about half of the respondents that came back to with our responses to the public consultation said that current lack of flexibility in some member states choose the type of governance structure that would fit the vision of the owner is an issue and is an important factor that sometimes can dissuade a company from listing. So what we are working on is a proposal on multiple voting rights, for example, that you will see as part of the package to be adopted next week. Research has been mentioned. The response to the public consultation showed that what has been done until now, and of course the rules on research have been reviewed as part of the CMU recovery package, CMRP. But what we hear is that perhaps it hasn't been done to sufficient extent. So we are looking into this, and we're looking also into the question of issuer-sponsored research, because I think today issuer-sponsored research is suffering from a bad stigma. And in some cases, perhaps it is justified because, of course, there is a potential conflict of interest. But at the same time, I think there are ways how to ensure that the conflict of interest is being mitigated. So we are looking into ways to mitigate the conflict of interest. So, I mean, these are the elements. We are trying to address the full spectrum. We're trying to look at, pre-IPO environment, IPO environment, and post-IPO environment. So as part of the post-IPO environment, we're also looking into the market abuse rules. And there, the responses to the public consultation were quite clear. There are things that we can do because the regulatory burden of compliance with market abuse rules is fairly high. So we are going to propose some changes there. And ultimately, I think the main perhaps focus of the review is to think a bit outside the box, and to try to also be a bit of a visionary, if I can use this word. It's difficult to be a visionary when you're a regulator. But I think what we need, given also the complexity and the duration of our lawmaking process, we need to anticipate certain developments. And in a way, we cannot afford, to fine-tune each time something comes, into light. We need to put forward something that makes sense and would make sense, today, tomorrow, and several years down the road. So this is the main objective and the emphasis of the proposal.
Thank you very much, Tanya. I must say you gave us much more information than I would have expected. So that has been very generous, because you really looked at it from a holistic approach. So you touched on the multiple voting rights, sponsor research, and then, as you mentioned, the targeted simplifications to the prospectus, to the listing directive, and also the market abuse rules. So we are definitely looking forward to seeing this, as you mentioned, balancing act. Very important to keep trust in the markets and to keep these capital markets growing. So we are running a little bit late, even though we inherited some delay, but still, I think we need to try to wrap up. So Tanya, you in fact made an excellent transition into the last round, which was precisely to brainstorm a little bit on the Listing Act. So you said it is going to be the package, if everything goes according to a schedule, will be published on the 7th of December. It's very soon. So I would like now to ask Adam from NASDAQ, what will be your reactions to what Tanya has been outlining, and what do you think should be the priorities to tackle in the Listing Act? So please, well, Adam, I will ask you, sorry, to be brief because we are right now late. Thank you.
I'll be very brief. So first of all, very inspiring to hear. Looking forward to see what the Listing Act contains. I think very interesting. If you look at MAR, for example, it's interpreted in 27 different ways across Europe. I think there is an opportunity to enforce how it should be interpreted. We see that in the Nordics, we see 3, 4, or 5 different ways of interpretation. That makes it unclear for the same advisors and investors and issuers to handle and manage. I think another aspect which is very interesting is the free float concept. Why are we the only alternative that is forcing companies to sell 25% if they have to access capital? We've looked at research in the US, free float is not a requirement. And we see that many companies with very little free float actually have good liquidity. So why are we still imposing this? Again, the measures and the issues it's not one single one. It's the holistic view and the cooperation with Tanya and the regulators locally on an EU level. We look forward to working with them, and we're very excited about what we heard and the potential ahead. So we remain at the regulator's disposal to discuss this further.
Thank you, Adam. Briefly, Álvaro, Vladimir, any comments?
For my side, from the side of the stock exchange or the SME growth markets, we cannot. After hearing Tanya, we cannot wait until next week to come because and have a look at that listing act. Because I remember last year we were commissioned. Or we were part of a group of experts that was commissioned by the European Commission to make a report on SMEs, and we find some obstacles on SMEs to access to growth markets or to public markets, and most of them we've talked about them today. The cost to go public and to stay listed, for example, or the lack of visibility of the companies, the lack of liquidity, lack of research, all these things that we've talked today and that Tanya and Andre were talking about and trying to solve. No? So the title of this report was making listing cool again. So I think that's what we have to do, to make listing cool again. And I think it's the best moment for doing it.
Very good. I very much agree with that formulation. Vladimir?
It was interesting to hear the comment about research. Let me share. I was building equity research in Central Eastern Europe. I was the head of research of Wood & Company in 95 till about 2008. And then actually Wood & Company is still running a team of about 35 analysts, and we provide research for about 200 companies. And of course, since the unbundling, which happened in 2011, 12, 13, we actually struggling how to pay for it. So that was wonderfully regulated. Of course, before that, the research was paid through bundled execution. As you remember, then we have to go through unbundling. We managed to convince some of our clients to pay for research. Since then, the research is loss-making. We keep cross-subsidizing it. And we, of course, struggle how to keep quality people in the research. And now and Europe is crying, why do we don't have research coverage? And why don't we have quality analysts? Because that's over-regulated. It's purely over-regulated. And I'm the last man standing to actually still providing the service or society. We're not making any money out of research. We're not able to cross-subsidize it. We are constantly being accused and have to demonstrate how we are separated from the issuers, are we not getting paid from anywhere, and we have all avoided all the conflicts of interest, and we are a private-owned company. Of course, in the first instance that was used by an American banks, JP Morgan specifically, because they provided all their research for 10,000 euros across all our markets in order to eliminate players like us from the marketplace, and many others, and the big banks cross-subsidizing it. They either sell it for free or for nothing. So we had to sort of very, very hard fight to keep quality analysts. And of course, we can't pay top people in the industry, which are protected, or actually their biggest at stake is the reputation of the firm and the reputation of their own. That's why they putting their recommendations. And since then, we keep sort of trying our best to keep the good people in it. I believe our research quality is still very high given the circumstances. But it's actually constantly painful discussion every year, and why we lost money in research. Are we going to do that? Stock exchanges are coming to us, okay, can we pay for it a little bit and give you a petty cash of 5,000 euros per year per company? I'm just like, I'm not going to pay the analyst from that anyway. I mean, this is not helping me, guys. Yeah. And issuers, now they're coming back and they try to pay us a little bit, but it's a huge uphill battle since the bundling. So think about the regulation, because you've regulated protecting marketplace by sort of missed research so much that you've eliminated the good research entirely from Europe. And now we're getting the consequences on the marketplace.
Thank you, Vladimir, for that observation, but let's hope that this is something that will be tackled. I think has been clearly mentioned as one of the main obstacles. Now, wrapping up, getting into towards the end of this very interesting discussion, I wanted to briefly touch on the fragmentation that we are also facing in Europe when it comes to cross-border investments. So we have company law, corporate law, insolvency law, withholding tax. All this is fragmented. We do not have a 28th regime yet, but very briefly, Andre, I know there is a lot of information here, but how do you see kind of the Parliament moving forward precisely to contribute, that we really improve the situation as we have today?
Yeah, indeed, as you said, very difficult questions, obviously. But I mean, we already heard, and there will be some initiatives in terms of market integration, and I think that's a good step forward. Obviously, in terms of how the European and national law are structured, it would be very hard to end up with a debate that we will have more harmonized civil law, corporate law, etc., etc. But I think the key, I'm not really sure that. I mean, in theory, the concept of 28 regime would be obviously perfect, or whatever the number would be at that time with other members joining the European Union. But I think politically, practically, it would be very hard to achieve that in foreseeable amount of time. But I think key there is actually to find those areas where the market integration can be achieved. To look at how we can harmonize. We will have also proposals from the Commission coming up on, for instance, on tax issues. I think that could be a good opportunity actually to come and look into areas where the tax issues are actually still fragmented and creating obstacles. But I think on top of that, we still see there's a lot of fragmentation in the single market as such. We haven't seen the completion, and I think we will have the celebration of 30 years of single market, but the single market is far from complete, especially in terms of the services area, the provision of services area. And I think this is particular a key point where we should look into, where we deal with not only the proposals that will come up, but also I think with the next upcoming policy initiatives to look at concrete issues where the cross-border action is actually providing a lot of obstacles, and whether there is something that we can do about it, either by providing more liberty, by possibility of passporting, by coming together with more harmonized rules on specific issues. I think there is a way to do it. I think it's really about the mindset that we have and focusing on the key issues that are there identified as obstacles when we reach cross-border.
Thank you very much, Andre. I think then we can conclude this panel with what seems like a good summary of all the aspects to consider, but also I think we can finish it in a much more positive note, definitely having listened to Tania Panova from the European Commission on what we are expecting for next week. So, of course, we will look at it carefully. We will try to contribute to the debate as we have always been doing. And obviously, we wish all the best to the incoming Swedish presidency and also the people that will be involved in the Econ Committee, because as the Commission mentioned, now is also collaboration from co-legislators to get this work done. Thank you very much for this lively discussion, and thank you very much to all of you for your attention. Now, Luc van Steenskiste, Chair of European Issuers, will give us the closing remarks of this FESE conference. Thank you.
Dear speakers and panelists, it's a great honor for me to have been selected by Rainer and by Peter to make the closing remarks as the representative of the issuers in Europe, who are basically the suppliers of information to the stock exchanges, but at the same time the users of the stock exchanges. I do not have any intention to make a resume of what has been said over here, because I'm first of all not a specialist of the business model of the stock exchanges, but I have listened with great interest and very attentionful to the discussions and the proposals of many of the people around the table of how to improve the present situation for listed companies in the European Union. Because let's come back to the basics of what we have today and what I think that is for us as companies important for the future and what is coming up. In relation to the past, you all know already, and it has been proved by a number of reports, such as the Oxera report and a number of several experts groups that have pointed to the macroeconomic risks of the European economies created by the loss of attractiveness of public markets as a source of finance, which, for example, is evidenced by the shrinking number of listed companies in the European Union. I know it's not that much about the big ones, but it's the shortage of IPOs and the small ones that have disappeared or the medium ones that have disappeared. A common suggestion of all those reports is that the regulatory framework for listed companies needs to be rebalanced to better reflect the company's perspectives and needs. And the intensity of regulation has steadily increased in the last 20 years. Although all the promises of everybody with good intentions to reduce the burden, it only did one thing: it increased and it increased and it increased. This has created, in many cases, unnecessary bureaucratic burden as well as compliance and legal risk associated. That's the situation of today. To this, over the last 3 years, we have witnessed the challenges created by the COVID crisis that are still ongoing in relation to the supply chain problems, which is causing a lot of difficulties for companies and raised the prices and inflation. The war in Ukraine, who made an additional big complex issue around the supply of energy at high cost. And at this particular moment, crucial moment, the companies that are confronted with new complex regulations, demands in relation to sustainability. And that specifically, and that's the third element, that is to make the picture complete. We all know that the upcoming climate change issue will create a major challenge for companies and in many cases impose a complete rethinking of the business model, which can only be realized through thorough and smart innovation and consequently the needed financial means to execute. And in this respect, bank financing is not enough. Certainly realizing that in Europe, stock market financing is only representing 1/3 of the financing of companies, while it is 2/3 in the United States. Over the next 3 to 6 years, and I have witnessed this as a member of the board of the Sustainability Board of EFRAG over the last 6 months, making the standards that have now been published and that are open for your reading. If you have time in the weekend, please do it. It's an amazing and enjoying moment in your life to do this. But over the next 3 years, companies will, more than 55,000 companies in Europe, European Union only, I'm not talking about the other ones, will be forced or obliged to provide information, and it's a substantial amount. We in the board have reduced quite dramatically the original standards, such a way that we could almost halve the demand, but still what is left over is a substantial amount and will cost a lot of money for companies to collect the data that are asked for. In this respect, big companies that are already on the sustainability road will probably manage this incremental cost to be done to respond to those standards that are now upcoming. But the smaller and medium companies that are not looking at GRI or any other sustainability standard in the world will have to start basically the work, and this will cost them a lot of money. I'm very sure about that. In the transition period, it will be very difficult. And afterwards, there will be a remaining cost for collecting the data. And then comes the next step. The next step is through the information stream coming to the market, they will not escape anymore to respond to the needs of sustainability, which is the need that I have just mentioned and that will be translated in need of financing. We also remain convinced that for smaller companies, to attract them to the market, besides all what I have said, there is an absolute need when they have made an IPO to give them at least a 3-year transition period so that they can become acquainted with the difficulties of the market. And today, this is still not in any of the Capital Market Union decisions taken up, although we have recommended it at many times. Because it's the only way for companies to be seduced, smaller companies to be seduced to go to the market, that they have to today known as being a very difficult exercise, a costly exercise, and Tatiana Panova has mentioned some of those costs already in her speech 2 minutes ago or half an hour ago. For companies, this is really something that is very important for them to have the capacity to try to respond to what is asked, but have the time to go in a transition period that allows them to do so. And last but not least, and I have witnessed that in the whole definition on the CSRD, the Corporate Sustainability Reporting Directive, we need to have a definition of small and medium enterprises. It's not because you have 40 million of sales and or 20 million of balance sheet and more than 250 people that you are a large company. In my eyes, you are a small company and you are at risk for everything in the next period to come up when you have to respond to all those requests of the European sustainability that is not contested. We have to do everything we can as companies to save the planet and to add our ambition to our additions to the climate change issues. But 40 million sales, 20 million balance sheet, they will need money to do so. And in many cases, the next step of risking that money will come from investors on stock markets and not from the banks. That's for me an absolute given. Because the demands will be, you will tell me of the 55,000 companies that I mentioned under CSRD, many of them are not stock listed. That's true. But the demand for the 45,000 that are not stock listed will already take a lot of the efforts and the capital of other ones. So we will need the stock markets as the ones that are capable of giving us the answer. To do that, we need, as companies that are providing the information, at least a transparent financial market proposition from all players. And we have already heard here in this room that also all the companies are asking for access to all the markets on a simple way in Europe so that they can have the capacity not only in their home market to go to the local stock exchange, but with an easy step to move to the other ones. Those are the two conditions that we see. Transparent system, I don't know what that means. I am not a specialist in the systematic insiders, neither in the dark rooms, but I know that there is something that is not correct and you have to, it has to be answered one way or another, how this is the issue that the stock exchange themselves have to solve. Against this background, oh, by the way, I want to mention that I have been seduced by the idea of somebody in this, I don't know, in the panel, that said, could we create a tax advantage system for investments in ESG-related sustainability projects, certainly for small and medium companies? I'm all in favor for it. I know it depends from something that is a local decision and a region, a country decision, but there could be a global European framework created to support that on a certain coherent way. So if there are many good ideas on the table, but this one was something that struck me specifically. Against this background, European Issuers believes that the conference has addressed many of the real issues and forms as such another important step in the dialogue with the European Commission to help them building a coherent and appropriate framework. I honestly believe that. We fully support the European Commission's initiative on the EU Listing Act, and I want to express, although she is not listing anymore, our gratitude for the excellent collaboration of our working groups with Tatiana Panova, Head of Unit Capital Markets Union of DG FISMA. The Listing Act initiative has indeed the potential to improve the financing and regulatory environment for European listed companies, and this way offers the opportunity to deliver growth and jobs for European economies, provided that the intensity of the regulation is reduced and made more affordable for listed companies of all sizes. And let me finish with a personal note. and conviction in relation to the upcoming regulation on sustainability, specifically on climate. Companies, because we have been, when you are sitting in those boards like the sustainability board of EFRAG, and I'm not telling you any secret, you are with little representatives of companies, and you are with many other people that have an interest in the sustainability as such. It strikes you that companies are the guilty ones for everything, and that the companies are the ones that are asked to solve everything. Companies are not solely responsible for climate change. They cannot solve everything. They are part of a community in which nations, countries, continents play a role, a major role, in the way they act. Saving the planet will not be done by overloading the companies with more and more regulation. We need to have a constructive dialogue with community as a whole, with governments, between companies, and with the NGOs, in order to find solutions together. If that is not realized, we will never make it. We will have to have peace in the room and positive thinking to make the climate change happening the way we want it to happen, and not the bad way. Last but not least, let me thank Peter Koblik, President and Rainer Ries, CEO of FESE, for organizing this interesting event, and congratulate them for their continued effort to give and help companies finding access to this very important way of financing their ambitions and needs for growth and wealth creation for all stakeholders of the companies. Thank you very much.